The chair is authorized to declare recess of the committee at any time. Before we get started with today's hearing, I would also like to ask unanimous request to adopt this resolution that was made available to all members that names our newest committee member, Mr. Norman, to his subcommittee assignments. Without objection, it is so ordered. This hearing is entitled Monetary Policy and the State of the Economy. I now recognize myself for 4 minutes to give an opening statement. Welcome back, Chair Powell, and congratulations on your confirmation as Chair of the Fed. Since you last came before the committee, Americans continue to struggle to make ends meet as the price of housing, gas, and groceries have skyrocketed. While it is important for the Fed to fight inflation, I would caution against any approach that ignores the Fed's maximum employment mandate and results in a recession with millions of people losing their homes and jobs. I hope you will also note that you should have noted that last week the House passed my bill, H.R. 2543, the Financial Services Racial Equity, Inclusion, and Economic Justice Act, which directs the Federal Reserve to consider the impact of all of its decisions, including setting interest rates on communities of color and underserved communities. Congress has a role in fighting inflation also. Housing is one of the largest contributors to inflation, and the housing shortage has allowed corporate landlords to hike up rents, forcing families to make difficult cuts elsewhere in their budgets. The Fed's interest rate hikes will make borrowing more expensive and thereby could help reduce out-of-control housing prices. But without action by Congress, inflationary pressures will remain because there is simply not enough affordable housing being built, and there won't be until Congress makes necessary investments. That's why it's so important that we pass the housing title of the Build Back Better Act, which provides over $150 billion towards new housing construction, modernizing existing structures for the long term, and providing supports to people can be stably housed. We're also facing corporate consolidation and greed. Without healthy competition to drive down prices, mega corporations driven by profit are exploiting their economic power to squeeze Americans to the breaking point. Democrats in Congress put forth solutions to tackle inflation, but my colleagues across the aisle have consistently voted against every solution. Let me go over some examples. Democrats passed a bill with $28 million in funding to address the baby formula shortage, but Republicans voted no. We passed legislation to crack down on price gouging from oil, gas companies, and Republicans voted no. Last week, Democrats passed my Racial Equity, Inclusion, and Economic Justice Act, and you guessed it, Republicans voted no. Republicans can talk about problems, but they have zero solutions. Let's also not forget that the Federal Reserve has more duties beyond monetary policy. Bank mergers and banking deserts are affecting access to credit for low-income consumers and communities of color. And working families who turn to cryptocurrency to generate wealth are now seeing their hard-earned savings disappear. Now more than ever, the Federal Reserve must work with other regulators to properly oversee the cryptocurrency market and provide guidance on a more stable alternative to volatile cryptocurrencies. Lastly, the confirmations of Lisa Cook, Susan Collins, and Philip Jefferson are historic, but more must be done to ensure diversity at the Federal Reserve. So, Chair Powell, I look forward to hearing your testimony this morning, and I now recognize the ranking member of the committee, the gentleman from North Carolina, Mr. McHenry, for 4 minutes to give an opening statement. And for those who may have please get muted so that Mr. McHenry can give his statement.
Thank you, Madam Chair, and thank you, Chairman Powell, for being back with us. A year ago, President Biden tried to buy support by signing into law a $2 trillion stimulus bill. What he did was sell out ordinary Americans who are now repaying all that quote-unquote free money. Inflation is the worst it's been in 40 years. American families are rethinking their long-awaited summer vacations because they can't afford a $5 a gallon price at the pumps. Costs are spiraling out of control for everything from housing and food to airfare, cars, medical care, and clothing. Democrats are still on the hunt for the scapegoat. They blamed oil companies, the war in Ukraine, and supply chain issues in Asia. But let's be clear. It's the Democrats' trillions in wasteful spending that resulted in higher grocery bills and soaring gas prices. President Biden continues to deny that the so-called American Rescue Plan contributed to inflation, recently calling that idea, quote, bizarre. Well, economists across the ideological spectrum, from former Clinton Treasury Secretary Larry Summers to Jason Furman to Michael Strahan, don't think it's bizarre. Even the left-leaning San Francisco Fed found that the American Rescue Plan contributed to price increases. So now millions of Americans need to be rescued from the Democrats' American Rescue Plan. I'm confident Chair Powell is taking this emergency seriously. And as I've said many times before, I think he's the right man for the job, and he is. But how the Fed manages the next few months will be as critical as any other period during the last 4 decades. No one at the central bank was prepared for prices rising at a clip of 8%, with even core inflation rising and running at 6% now. Republicans have long warned about the size of the Fed's balance sheet, but it grew by nearly $1 trillion over the last 12 months alone. And now it seems the previous predictions by the Open Markets Committee about economic projections are wrong, and they are altering course. Simply put, the Fed has its work cut out for it. Lastly, I want to address the left's ongoing efforts to expand the Fed's dual mandate. Republicans have been on the record opposing this, and I hope that the skyrocketing inflation unleashed under the Biden administration puts an end to these discussions. The Fed should be focused on price stability. That should be their single-minded focus at this moment in time. It's out of touch for Democrats to keep pushing mission creep at the Fed when American families are struggling to feed themselves and to get work. The Fed is a serious place with serious business to attend to. It needs to focus on the middle class, not the chirping political class. This was true before inflation broke out. It's all the more obvious to today. I hope that Chair Powell will deliver that message to his colleagues throughout the institution. And again, I want to thank Chair Powell for his testimony. Thanks for his willingness to engage with policymakers on the Hill. And thank you for his openness in what has been a more closed-off institution. We have a mess to clean up. And we know that you're taking your job seriously. I'm glad you're taking your job seriously. And with that, Madam Chair, I yield back.
Thank you, Ranking Member McHenry. I now recognize the Chair of the Subcommittee on National Security, International Development, and Monetary Policy, the gentleman from Connecticut, Mr. Himes, for 1 minute to give an opening statement.
Thank you, Madam Chair, and welcome, Chairman Powell. Congratulations on your confirmation. I don't remember a moment as consequential as this one for the Federal Reserve, or as potentially testing of its leadership. I think I have to go back to the end of 2008 and the first quarter of 2009 to think of a moment that was quite as important as Americans watched the economy collapse around their ears and their jobs and assets being lost. There is a very real possibility that Americans will be caught in a vice, an economic vice, not of their own making, between inflation, which makes their everyday lives unaffordable, and the possibility, much contemplated by economists, of a recession. Simply put, as one of the last members of Congress to get out of the chamber when it was under attack on January 6, 2021, I don't believe that our democracy can sustain either runaway inflation or another recession. And despite the rhetoric you'll hear all day today here, there's not a lot that we can or will do Much of this rests on your shoulders. So Chairman Powell, I just ask that as you make your decisions, you think not just of the numbers and the economics, but of the importance of sustaining this nation's democracy.
Thank you, Mr. Himes. I now recognize the ranking member of the Subcommittee on National Security, International Development, and Monetary Policy, the gentleman from Kentucky, Mr. Barr, for 1 minute to give an opening statement.
As we face the worst inflation the country has seen in 4 decades, I am encouraged to have Mr. Powell leading our central bank, and I'm hopeful the Fed will rise to the occasion. At the same time, it's important to remember the following. Just last year, Democrats were ignoring inflation warnings to pass a $2 trillion stimulus bill. They were pushing the Fed to solve climate change and social ills, and they flirted with unconventional monetary tools like yield curve control. Today, as gas prices top $5 a gallon, these left-wing ideas seem like a fever dream from an alternative universe. But many Democrats fell for them at the time, and they'll likely pursue them again if inflation subsides. The lesson for the Fed is clear. It needs to focus on doing a limited number of jobs well and not get distracted by those who want it to be all things to all people. Specifically, the Fed should be laser focused on its price stability mandate. And even as you acknowledge the risk of recession and as everyone desires a soft landing, I encourage the Fed to have fortitude to prioritize defeating this inflation scourge. Chair Powell, I hope you are hammering this message home at the Fed as ordinary Americans see their paychecks eaten away under Democrat mismanagement of our economy.
I want to welcome today's distinguished witness, the Honorable Jerome Powell, Chair of the Board of Governors of the Federal Reserve System. Without objection, your written statement will be made part of the record. Chair Powell, you are now recognized for 5 minutes to present your oral testimony.
Chairwoman Waters, Ranking Member McHenry, and other members of the committee, I appreciate the opportunity to present the Federal Reserve's semi-annual monetary policy report. And I'll begin with one overarching message. At the Fed, we understand the hardship that high inflation is causing. We are strongly committed to bringing inflation back down, and we're moving expeditiously to do so. We have both the tools we need and the resolve it will take to restore price stability on behalf of American families and businesses. It is essential that we bring inflation down if we are to have a sustained period of strong labor market conditions that benefit all. I will review the current economic situation before turning to monetary policy. Inflation remains well above our longer-run goal of 2%. Over the 12 months ending in April, total PCE prices rose 6.3%. Excluding the volatile food and energy categories, core PCE prices rose 4.9%. The available data for May suggests that the core measure likely held at that pace or eased slightly last month. Aggregate demand is strong, supply constraints have been larger and longer lasting than anticipated, and price pressures have spread to a broad range of goods and services. The surge in prices of crude oil and other commodities that resulted from Russia's invasion of Ukraine is boosting prices for gasoline and fuel and is creating additional upward pressure on inflation. And COVID-19 related lockdowns in China are likely to exacerbate ongoing supply chain disruptions. Over the past year, inflation has also increased rapidly in many foreign economies, as discussed in a box in the June Monetary Policy Report. Overall, economic activity edged down in the first quarter as unusually sharp swings in inventories and net exports more than offset continued strong underlying demand. Recent indicators suggest that real GDP growth has picked up this quarter, with consumption spending remaining strong. In contrast, growth in business fixed investment appears to be slowing, and activity in the housing sector looks to be softening, in part reflecting higher mortgage rates. The tightening in financial conditions that we have seen in recent months should continue to temper growth and help bring demand into better balance with supply. The labor market has remained extremely tight, with the unemployment rate near a 50-year low, job vacancies at historic highs, and wage growth elevated. Over the past 3 months, employment rose by an average of 408,000 jobs per month, down from the average pace seen earlier in the year, but still robust. Improvements in labor market conditions have been widespread, including for workers at the lower end of the wage distribution, as well as for African Americans and Hispanics. A box in the June Monetary Policy Report discusses developments in employment and earnings across all major demographic groups. Labor demand is very strong. While labor supply remains subdued, with the labor force participation rate little changed since January. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and price stability for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship, especially on those least able to meet the higher costs of essentials like food, housing, and transportation. We're highly attentive to the risks that high inflation poses to both sides of our mandate, and we're strongly committed to returning inflation to our 2% objective. Against the backdrop of the rapidly evolving economic environment, our policy has been adapting, and it will continue to do so. With inflation well above our longer-run goal of 2% and an extremely tight labor market, we raised the target range for the federal funds rate at each of our past 3 meetings, resulting in a 1.5 percentage point increase in the target range so far this year. The committee reiterated that it anticipates that ongoing increases in the target range will be appropriate. In May, we announced plans for reducing the size of our balance sheet and shortly thereafter began the process of significantly reducing our securities holdings. Financial conditions have been tightening since last fall and have now tightened significantly, reflecting both policy actions that we have already taken and anticipated actions. Over coming months, we will be looking for compelling evidence that inflation is moving down, consistent with inflation returning to 2%. We anticipate that ongoing rate increases will be appropriate. The pace of those changes will continue to depend on the incoming data and the evolving outlook for the economy. We will make our decisions meeting by meeting, and we will continue to communicate our thinking as clearly as possible. Our overarching focus is using our tools to bring inflation back down to our 2% goal and to keep longer-term inflation expectations well anchored. Making appropriate monetary policy in this uncertain environment requires a recognition that the economy often evolves in unexpected ways. Inflation has obviously surprised to the upside over the past year, and further surprises could be in store. We therefore will need to be nimble in responding to incoming data and the evolving outlook. And we will strive to avoid adding uncertainty in what is already an extraordinarily challenging and uncertain time. We're highly attentive to inflation risks and determined to take the measures necessary to restore price stability. The American economy is very strong and well-positioned to handle tighter monetary policy. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you, and I look forward to your questions.
Thank you very much, Chairman Powell. Chair Powell, at your Senate confirmation hearing, you were asked about the possibility that inflation is being driven by corporations in concentrated sectors of the economy. You said, and I quote, "That could be right. It could also just be, though, the demand is incredibly strong and that, they're raising prices because they can," quote, unquote. We're all seeing and feeling the effects of inflation on consumer pocketbooks, but corporate profit margins are not hurting. In 2021, the profit margins of the S&P 500 index surpassed 12%, the highest profit margin on record, and is expected to be even higher in 2020. Corporate greed and consolidation are driving higher and higher prices for consumers above and beyond any inflationary pressures. Just last quarter, Tyson Foods, which sells 1 out of every 5 pounds of meat sold in the United States, claimed that their higher prices are due to rising labor and freight costs. Yet, they still managed to net an additional $500 million in quarterly profits. When it comes to rents, a corporate landlord recently remarked, and I quote, "We have an unprecedented opportunity to really press rents on renewals because the country is highly occupied. And so, where are people going to go? They can't go anywhere. We have a tremendous opportunity to press both on renewing leases for existing residents and to reset market rates, which we've reset numerous times, even this year," end of quote. This kind of blatant profiteering on the backs of hardworking families is simply outrageous. Could you elaborate on the role that corporations play in setting prices and how that is affecting inflationary pressures today. Would you also elaborate on what you meant when you said perhaps corporations are raising prices, quote, because they can?
Sure. So matters of concentration in the economy represent a series of interesting questions that are largely not settled. For one thing, it is clear that our economy has become more concentrated, largely due to lower levels of formation of smaller businesses. That has happened. It is not at all clear that there's a connection between a more concentrated economy and, for example, inflation. And of course, matters of corporate concentration are outside the jurisdiction of the Fed. Those are for the competition authorities and really not for us to discuss. In terms of why prices are going up, I think a lot of it has been, a lot of the places where prices have gone up quite a bit have been situations where supply is constrained and demand is very strong. And so take cars, for example. The demand for cars went up a great deal during the pandemic. People wanted to ride in cars rather than public transportation, and they wanted to move to the suburbs and things like that. Rates were low. The economy was stronger than people expected. But the companies couldn't really make more cars because they couldn't raise their output because of the lack of semiconductors. So when demand hits fixed supply, what happens is prices go up and margins went up. And so I think as the economy returns to normal, we would expect those profit margins to return to more normal levels.
Well, Chairman Powell, the example that I gave of Tyson, who said their prices were rising because of labor and freight costs, and yet they managed to net an additional $500 million quarterly profits.
I apologize. I'm having a hard time hearing your words. I'm sorry.
Okay. The example that I gave of Tyson Foods and the fact that they said that their prices were rising due to labor and freight costs, yet they managed to net an additional $500 million in quarterly profits. How do you explain that?
I'm not familiar with their profit and loss statement, but I will say, and again, there may be particular industries where there are competition issues. I don't know that. It's really not our focus or our authority.
Well, do you have the opportunity to look at rising costs and identify corporations where they are gaining substantial profits, yet they keep raising their prices? Do you have a way of examining that?
I think we can see that, but I think, you know, our job is to keep, you know, maximum employment and price stability. So we're not in the business of regulating individual companies or determining whether their actions, for example, are anti-competitive or that sort of thing. That's more for elected people and also for the competition authorities. So we do look at that, but again, I think a great deal of the price increases that you saw were a matter of supply being unable to meet demand, and the result was prices moving up. In many cases, that was the story.
Thank you very much. The gentleman from North Carolina, Mr. McHenry, who is the ranking member of the committee, is now recognized for 5 minutes.
Thank you, Madam Chair. I would, on this debate about corporate profits, I would commend to the committee Secretary Yellen's statement where she rejects the idea of corporate greed is to blame for inflation, and I concur. We have a complex set of issues. The fiscal house was certainly different than monetary policy, and the extraordinary nature of the partisan American Rescue Plan and the $2 trillion injected into a recovering economy and Democrat policies to keep people out of the workforce for longer than the rest of the Western world also contributed to inflation. So that is a political debate here on Capitol Hill, Chairman Powell, and that is on the political side. What I want to ask you about are the policy tools that you are using. Now, certainly you, as chair of the Fed and the Open Markets Committee, took extraordinary measures in the midst of the pandemic to ensure that we didn't have further contagion, and including extraordinary lending facilities, purchasing securities, keeping the federal funds rate at zero. These were the right tools at the right time. On the fiscal side, you had a partner with bipartisan bills to keep our economy afloat during government shutdowns. But like all the good firefighting measures, we should put them away when times change. I want to talk to you as you put these measures away, how you expect the economy to respond. So let's start here. What is your level of commitment to fight inflation?
Well, so it's unconditional, our commitment is, and the reason is that we need to, in a particular situation, we have a labor market that's sort of unsustainably hot, and we're very far from our inflation target. We really need to restore price stability, get inflation back down to 2%, because without that, we're not going to be able to have a sustained period of maximum employment, where the benefits are spread very widely and where people's wages aren't being eaten up by inflation. Really, it's something that we need to do, we must do, in order to have that kind of a labor market. We'll need to do it.
So as you pull back these emergency measures from COVID and you normalize rates to what they look like sort of in the long run, how do you expect the economy to respond?
So when we raise interest rates, and also to a lesser extent when the balance sheet shrinks, what happens is rates go up across the economy and financial conditions generally tighten. And you can think of it as in interest-sensitive spending is an important place that'll be affected, and that's things like automobiles and other durable goods. If rates are higher, then demand for cars will moderate, will decline a bit. The second channel would be asset prices generally. We don't target any particular asset prices, but higher interest rates tend to bring them down broadly. That tends to mean a little bit less spending because people's wealth has perhaps declined a little bit. And the third channel can be the exchange rate, where that also has disinflation effects. So overall, we have these effects on the economy. Our intent, of course, is to bring inflation down to 2% while preserving a strong labor market. As I've mentioned, that has become significantly more challenging with the events of the past few months, particularly the war, which is driving gas prices up and raising energy prices and also food prices and disrupting supply chains further.
So at the same time, you have a massive balance sheet. First begin with mortgage-backed securities. As we have a roll-off of the Fed's balance sheet of mortgage-backed securities, what are expectations for how that affects housing?
So I think what will affect housing is the rate. The housing industry and market are slowing down from a very, very hot pace, and that's partially because of higher mortgage rates. The effects of shrinking the balance sheet will be marginal compared to the effects that we're seeing and expect to continue to see from rates rising mortgage rates.
But what are your expectations and any further announcements? Can we expect further announcements on the assets you hold and the securities you hold? Or are there going to be balance sheet announcements in the coming weeks?
No, I would say this. We have a plan. We've articulated it. The markets are forward-looking. They see it. And the markets are in a good place, I think, understanding what we're going to do. And that's we're going to be allowing these securities to mature and run off our balance sheet at a pace that we've said. And it'll be 90 or 95 billion, I guess, by September. Now it's about half of that. So that's what we've done, and we expect, the idea is that that'll just be on an ongoing basis in the background, and we think the markets can handle that. Treasury issuance is way down, so we think there will be demand for these securities. The Treasury will then reissue them in whatever form they think is appropriate when it relates to Treasuries. So,
Thank you.
The gentleman from New York, Mr. Meeks, who is also the chair of the House Committee on Foreign Affairs, is now recognized for 5 minutes.
Thank you, Madam Chair. Mr. Chair, it's good to see you, and I know you'll hear a lot of probably political stuff going back and forth, but the American public is trying to understand the language of which we're talking today so that we can really understand what inflation is. Fact of the matter is, I just recently was over in Europe. There's inflation in Europe, just like there's inflation here, although as I talked to Christine Lagarde and others, they say the cause of the inflation may be different. So if the causes are different, they said that maybe demand here, but not a case of demand there, is to resolve inflation in Europe. For example, I was in Moldova, 30% inflation rate, gas $15 a gallon, turkey 80% inflation rate, gas $13 a gallon, and I could name places in Europe from Europe to the United States. Is it that we had, whether it's the supply chains, the China shutdown, complete shutdown, the zero COVID policy, Russia's war in Ukraine, COVID period, isn't just a massive storm of everything is what contributes to inflation and causes it all over the world?
Pretty much. Yeah, that's pretty good description.
It's a little bit of everything, right?
But
so
it's-
if I'm
but it's
talking to my
different.
constituents, trying to explain to them what inflation is and what causes it, I would not single out any one thing. I would probably have to talk about the conglomerate of things, because if you take away 2 or 3 of those things, we might not be in the situation here. All of it unprecedented, all of it really out of the control of anyone, out of control of Democrats, out of control of Republicans, out of control of the president, out of control of other governments. Is that not correct?
So some of it is out of our control. For example, the price of oil and most of the price of food. And to your point, Europe has it's much more about energy and food prices, very difficult problems. And also they, of course, have the European Central Bank has different countries, which, and so they have to worry about the spreads between different countries, and that's a different challenge that we don't have here. The difference here for us is we actually have a very strong economy and well-recovered economy, and so more of our inflation is from demand, and we do have tools to deal with demand. That is the place where we actually can work, and that's what we're using our tools for.
And some of that was because during the crises that we had to do certain things, stimulus and other things to make sure that we kept our economy stable. I mean, if without doing those things, we would have been in trouble. So the things that we did going through COVID, the stimulus, trying to make sure people kept their jobs or kept money coming in at the time was what we had to do. Otherwise, we would have been in worse shape or not have as strong an economy as we have now compared to other countries. Is that not correct?
Yes, I would say it this way, that our inflation is a consequence of very strong demand, in part driven by supply, by what Congress did to support activity, in part driven by what we did, but also...
But that helped stabilize our economy at that time, right?
It did.
And if we did not do those things, our economy may not be as strong as it is right now.
I think that's right.
That's
so
correct.
Our economy is strong.
And let me jump to something else real quick, because the one other thing, I know you testified before the Senate yesterday, and what concerned a number of my constituents that I talked to was the question about can we resolve inflation without increasing unemployment? Because our folks are concerned about losing their jobs and not being able to, it'd be worse if they were unemployed. So my question to you is, can you speak to what the Fed has seen during the last few years with respect to the relationship between unemployment and inflation? And is it possible that we can continue to have a strong labor market while also curbing inflation?
It's certainly possible that we can. And there is a relationship between unemployment and inflation. The challenge now is that inflation is at a 4-decade high, and some of it we can deal with, some of it is really going to be dealt with on global markets, the price of oil and that kind of thing, and we can't affect those. But the challenge is we're tightening monetary policy, and that's designed to drive growth down to a level that's more sustainable and lower, give the supply side a chance to catch up, and give inflation a chance to come down and bring inflation down. That's what we're trying to do. We don't have precision tools, and we raise and lower interest rates. It affects the whole economy through many channels, and so there is a risk that unemployment would move up from what is a historically low level. Though a labor market with 4.1% or 4.3% unemployment is still a very strong labor market. Today's rate is 3.6%, and there are 2 vacancies for every unemployed person. So that's a labor market that's kind of overheated.
The gentlewoman from Missouri, Mrs. Wagner, is now recognized for 5 minutes.
I thank you, Madam Chairwoman. Chair Powell, thank you for joining us again today. I just want to start by saying how sick and tired I am of the president's inflation blame game. One day it's Putin's fault, another it's the oil companies and the meat packers, or perhaps it's corporate greed. Now we're blaming other countries like Estonia, Turkey, Europe. I give you my avid assurance that no one in Missouri's 2nd Congressional District gives a rip what the price of gas and groceries are in Europe. They care about what they are at the corner of Manchester Road and Weidman. No one in this administration is willing to accept responsibility for the dismal economic situation America is in today. Inflation, sir, more than tripled in 2021, from 1.4 to 7%. And from June to the end of September 2021, inflation hovered, I think, around 5.4%, and then began a steady increase until reaching an historic 8.6% that is now crippling Americans' spending power today. Chair Powell, when inflation remains steady at 5.4% during that period in 2021, what factors played into the Fed's decision to keep rates at nearly zero during each FOMC meeting in June, in July, and in September of 2021, sir?
So during the summer of 2021, just giving us hindsight, inflation was coming down month by month. If you look at monthly readings for CPI or PCE, they were coming down month on month through September. And so that I think, told us that our thesis that this was going to be a passing inflation shock was at least plausible. I think that the data turned pretty hard in October and November, and we very much changed our position, and since then have tightened financial conditions quite significantly. So it was a matter of a few months when we were really looking at this and thinking it's going to be passing. Most macroeconomists thought that it would be a passing thing. It turned out to not have been so far, and so.
But we saw it move from 1.4% to 5.4%. So I don't, we did have a steady period of time. I wouldn't say that it was declining, but I'm just surprised that we weren't moving more quickly at the Fed. I mean, I want to be honest, sir, that the Fed, I think, underestimated actual inflation. What do you think you missed?
Well, we did underestimate it. With the benefit of hindsight, clearly we did. So it comes down to this judgment that we had to make. It has really nothing to do with our framework or anything like that. And every central bank had to make the same judgment, which was looking at the supply chain problems and the shock to labor force participation, millions of people out of the labor force. We had to decide whether that was going to be a lasting thing or whether it would kind of turn around quickly. We had very high levels of labor force participation. Suddenly they're much lower. The thought was people will come back. As soon as COVID is over, we have these new vaccines. Every American is going to get vaccinated. We'll be done with COVID by the end of the year. So basically, these supply side issues, broadly speaking, just didn't get better. There were recurring waves, and that was the judgment we had to make. We knew it could be wrong, and I think when it started to look pretty wrong, we pivoted. And
Now, President Biden continues.
Like 7 months ago.
President Biden continues to say that a recession is not inevitable, as his government agencies, and Dems in Congress continue to spend billions and trillions of taxpayer dollars, burden businesses with costly rules and regulations, and on top of it, the president refuses to unleash American energy independence. The president's policies continue to take inflation-taming options, I think, off the table and hamstring the Fed's ability to focus on price stability. President Biden not only limits the energy production here in America and spends trillions of our taxpayers' money, but he also threatens tax increases and promises to cancel billions in debt. How can you still say, sir, that the Fed has a pathway to a soft landing for the economy?
Well, that's our intention is to achieve inflation getting back to 2% and
with all I've laid out,
a strong labor market. I'm sorry?
With all I've laid out and the increases you're going to have to take.
So as I mentioned, I think that path has gotten more and more challenging thanks to the effects on oil prices and food prices really, and also the supply chains from the war in Ukraine. It was never going. We never said
Not
it was
just
going to
the
be
war in
easy.
Ukraine, sir.
Well, it's the rise in energy prices and the rise in, which has been, began in February, the latest rise from February.
The latest rise. This has been going on for a year and a half. I appreciate the chair's indulgence. I will yield back the balance of my time. Thank you, Chairman Powell.
The gentleman from Texas, Mr. Green, who is also the chair of the Subcommittee on Oversight and Investigations, is now recognized for 5 minutes.
Thank you, Madam Chair. Thank you for being here, Chair Powell. I greatly appreciate the opportunity to have a few thoughts with you, share some thoughts. In February of 2021, you indicated that millions of people were out of the labor force, which is what you've said today, millions. And with millions of people out of the labor force, the Biden administration and persons on my side of the aisle sought to do something about that, to help those who were unemployed. The inflation that my colleagues speak of has to do with unemployment, the help that we gave people who were unemployed at the time. Persons who are unemployed, Mr. Chair, they need help. They can't feed their families. Small businesses were screaming for help. We helped small businesses to get through a turbulent time. This was a pandemic. The vaccines had to be distributed and developed. That's a part of that inflation that they're speaking of. People needed rental assistance. People were literally going to be evicted by the millions, but for the assistance from the Biden administration and Congress. We wanted people to go to work. We provided some child care. If you want people to go to work, schools are closed. You got to help people through these turbulent times. They never talk about what the inflationary costs that they speak of really did, how it benefited American people who were suffering. They overlooked that. They weren't going to help, and now, since they didn't help, they're going to say everything that they can to demean the help that was given. No, they didn't vote for it. They don't extend the hand of friendship to people in times of need. So when they don't do that, they have to find a way to denounce the help that was given. It's really shameful. It's painful, and it's sinful to hear people use a term, inflation, to indicate that people who were unemployed shouldn't have received help. The small businesses that were begging for help shouldn't have been helped. Vaccines shouldn't have been distributed. People shouldn't have gotten rental assistance. They shouldn't get child care. Now, I would respect them if they would say these things, that these are things that they opposed. But they're not going to do that. They use one word, inflation. And unfortunately, our messaging to all of the American people has been somewhat lacking. But I want the people that I serve, who pay attention to the supermarket more so than the stock market, to know that when they needed this help, we were there for them. And Mr. Powell, you indicated that there were millions of people out of work in February of last year, just prior to this help being accorded people. I welcome your commentary.
I'm sorry.
I welcome your commentary.
You welcome my commentary. Sorry, I didn't catch the last part. So, our job is maximum employment and price stability. We did what we did during the pandemic, acute phase and response, and you did what you did, and now we are where we are. And so we have a job to do, and it's very important that we do it, not least because of the people you talk about. The people you talk about are really suffering from inflation now at the grocery store. And the only way we can get back to that get back to a place where inflation is low again, get inflation back down to 2%, and help those people, is by trying to get demand and supply back in balance.
Let me intercede and say this. You said something that I find favor with. You said, we did what we had to do. We did what we had to do. We did what we had to do. We were the adults in the room who did what had to be done. Others who declined to do can now be critical. I yield back.
Thank you very much. The gentleman from Minnesota, Mr. Emmer, is now recognized for 5 minutes.
Thank you, Chairwoman Waters. Thank you for holding this hearing, and thank you, Chair Powell, for your testimony and your time here today. Financial freedom is American freedom, and frankly, Americans do not have the financial and economic freedom they need to invest in themselves, their businesses, and their families. Unfortunately, Americans are too busy making ends meet to focus on anything else. Inflation is running rampant across the United States, with consumer prices rising 8.6% in the past year, the largest price increase since 1981. From fuel to meat to housing, my constituents and all Americans are suffering at the hands of this hidden tax, except it's not so hidden anymore. It's punching Americans in the face, as my friend Mr. Stile put it yesterday. So how did we get here? It's pretty simple. We gave up American energy independence. We locked down our citizens and businesses for nearly 2 years, pumped the economy with well over $5 trillion in what's called stimulus funds. And now, as we recover from the pandemic, we simply do not have the energy resources necessary to meet the increased consumer demand. There's a history of Democrat policies we can point to that put us in this position, from refusing to adopt an all-of-the-above energy strategy to recklessly passing $2 trillion in partisan spending through the American Rescue Plan, despite the fact that nearly $1 trillion of bipartisan relief was unspent. But the bottom line is we need solutions now because inflation is beating up the American people. We have to wake up and realize that we cannot continue these spend-your-way-to-prosperity policies. Everyday inflation threatens the financial security of American families, of our constituents. We need solutions. Let me just return to my point about the spending. In December 2020, we'd authorized nearly $4 trillion in bipartisan COVID relief. Yet just 3 months later, Democrats pushed through another $1.9 trillion with hardly any oversight mechanism included, even though a quarter of all COVID relief remained unspent. When President Biden was recently asked if the $1.9 trillion spending bill caused inflation, he said he didn't think the bill had even a minor impact and called the idea, quote, bizarre. Chair Powell, do you agree with the President's conclusion that the $1.9 trillion that was included in the American so-called rescue plan had not even a minor impact on the inflation we're seeing today?
I'm sorry, I wouldn't comment on what any elected official said, and it's really not up to us to score fiscal interventions.
Again, sir, if you would, respectfully, I'm not asking you to comment on what the President said. I'm asking you personally, do you believe that the $1.9 trillion American Rescue Plan did not even have a minor impact on the inflation we're seeing today?
We didn't comment on the Tax Cuts and Jobs Act, we didn't comment on the CARES Act, and we won't comment on that act. And from that standpoint,
it's interesting, sir,
reclaiming.
It's interesting, sir, that you won't comment on this, but you were more than willing a year ago to talk about inflation as some transitory something that everyone has acknowledged now. It's going to be here for a while. Even though it seems like the President's Build Back Better package, this massive spending package, is dead on arrival, certain elements might not be dead. Chair Powell, do you have concerns that if Congress injects a new round of stimulus into the current economy, it could, and in fact will, add to the inflation we're seeing today?
Again, really, it's not our role to give you advice on what to do. You know, we report to Congress, not the other way around. We're sticking to our mandate and our mission, and we have a lot of work to do on that front, and not really giving you advice on what you should be doing. We take fiscal policy as something that comes to us, and we deal with it as part of everything else.
I'm very disappointed, sir. I mean, you are supposed to be in charge of the monetary policy of this country. You're now embarking on raising interest rates because that's the only tool you think you have left. This is not just a dog chasing its tail anymore, sir. This is a dog that's starting to devour its tail and its back end because of the debt that we are carrying. I want to thank you. You acknowledged we're in a bad spot. We're knowingly walking toward an even worse inflation, a recession, and God forbid, food shortages. Yet we're relying on old monetary policy tools to keep us from falling off a cliff. Sure, we can raise interest rates over and over, but the only way to curb in a disaster this bad is to raise interest rates to a catastrophic level, or as like Larry Summers suggested, we allow unemployment to go to historical highs. It's not feasible. We need to put ourselves on a strict spending diet. And we have to have strict oversight on the funds that Congress has already allocated to make sure not even one single dollar is going to waste. And we need to put control back in the hands of small businesses on Main Street. Thank you.
The gentleman from Connecticut, Mr. Himes, who is also the chair of the Subcommittee on National Security, International Development, and Monetary Policy, is now recognized for 5 minutes.
Thank you, Madam Chair. And Mr. Chairman, if you'll indulge me 1 minute. It's important for the American people to understand what's being said here today, because it's being said in other rooms in this building. What the American people are seeing today is something that my Republican Party friends have given over to recently all too often, and that is rank dishonesty in the service of acquiring and retaining power. A party without any resilient or discernible principle has stumbled upon inflation. There's inflation all over the world. Germany, Japan, Africa, South America, the United Kingdom. There's inflation all over the world. But the Republican Party has decided that inflation is Joe Biden's fault, or the American Recovery Plan's fault. I've read the monetary policy report from start to finish. It gives the Russian invasion of Ukraine, supply chain bottlenecks, high fuel costs, high wage growth. It does not mention Joe Biden or the American Recovery Plan. By the way, the American Recovery Plan is a particularly rank piece of dishonesty. Set aside the fact that it cut childhood poverty in half. As Mr. Green pointed out, if that isn't something to celebrate and to perhaps have the slightest bit of humility as you attack it, I don't know what I can do for you. The American Recovery Plan, as Mr. Emmer pointed out, was about 1/3 to 1/4 of the fiscal efforts that this Congress made on a largely bipartisan effort to lift our economy to the point where it is today. The chairman said, strong and well recovered. Unemployment at 3.6%. So many jobs out there that many of them are going unfilled. Did we overshoot? Maybe we did. But the American Recovery Plan, this thing that cut childhood poverty in this country in half, was about 1/4 to 1/3 of the fiscal efforts. The other money was supported by President Trump. But by the way, it's not those dollars that are still sitting in Americans' bank accounts. It's not CARES dollars. No, that was supported by the Republican Party. It's only those dollars in the American Recovery Plan that cut childhood poverty in half. Energy prices. I read the monetary policy report. I'll quote it. Because of the Russian invasion of Ukraine, oil prices rose sharply. I've been around here long enough to know that putting facts and truth out is like spitting into a hurricane, but it's important for the American people to understand that. Mr. Powell, I released yesterday, I hope you got a copy, a white paper on a central bank digital currency. It's offered with humility because we have a lot of issues to work out, but I hope you've had a chance to take at least a quick look at it. I wonder if you have any reflections, or importantly, what are the next steps now that you've gotten commentary from lots of people? What's the next steps with respect to the Federal Reserve thinking about a CBDC?
So I did have it. I printed it out. I have it here. I have not had a chance to read it carefully, obviously, given all that's going on. But no, so I think generally we're doing a great deal of work. The President signed an executive order, and administration, parts of the administration are working on this. I think it's something we really need to explore as a country. It should not be a partisan thing. It's a very important potential financial innovation that will affect all Americans. And our plan is to work on both the policy side and the technological side in coming years and come to Congress with a recommendation at some point, and we don't prejudge what that would be. I know your views are very positive on it, but I think one thing I did see in your report was the beginnings of thinking about how Congress might authorize it, and I do think that's a very, very important aspect of this, and it's great to have Congress starting to think about that.
Thank you. Thank you. I think I agree with that, and I think that has bipartisan support. In my remaining minute, I'm going to ask you a question I ask you a lot, Mr. Chairman. We're obviously seeing pretty dramatic swings in the financial markets. Money is no longer free. We're seeing that in the SPAC market, the high-yield market, the equity markets, cryptocurrency. In my very short remaining time, Mr. Chairman, what should we be focused on? What is concerning you with respect to systemic risk that may develop in the face of rising rates and rising inflation?
So, you know, basically the financial markets have been functioning well, and the banking system in particular is very strong, well capitalized, lots of liquidity, better understanding and management of its risks. The place where there have been issues, and we don't see them elevated at this point, has been illiquidity in some markets relative to where it had been historically. But
any markets in particular where you worry about illiquidity?
No, I wouldn't say that we're seeing anything that's particularly concerning. But I think sort of systematically, liquidity in the Treasury market has come down from where it was, and we've been looking for some time at ways to address that. But the markets are clearly functioning reasonably well.
Thank you. Thank you. My time has expired.
Thank you. The gentleman from North Carolina, Mr. Budd, is now recognized for 5 minutes.
I thank the chair. Chairman, thank you again for being here. According to the Congressional Budget Office, the federal government will spend an average of $545 billion per year, which was the estimate before rates went up. And these are on interest payments on the $31 trillion of national debt. So that's $545 billion is more than we spend on the Department of Veterans Affairs. So given that the national debt is currently at about 125% of GDP, with the Fed's commitment to tackle inflation, would that be limited by rising interest rates, making the servicing of the national debt even more expensive?
No, absolutely not.
Explain that.
No, we're not in a situation where we need to consider fiscal questions like that. The U.S. is on an unsustainable fiscal path, meaning the debt is growing faster than the economy, but it's not in an unsustainable position. We can service our debt, and the markets understand that, and we can conduct our policy without thinking about questions of fiscal sustainability, and we do.
When your colleague, Secretary Yellen, was before this committee, she told me that federal debt, which was then about 105% of GDP, she said, quote, "That's not a number that I think is fiscally irresponsible." She also went on to say, quote, "If interest rates are zero, we could substantially have a higher debt burden." And in the formula in the following question, she alluded to Japan and the fact that it could be about double of where we are now, meaning about $60 trillion of debt if you use her math. So do you agree with Secretary Yellen that having a national debt of over 100% of GDP is fiscally responsible, given that interest rates can change and that historically low interest rates can't always be expected?
I guess I would say it this way. We're not on a sustainable path, and we haven't been for some time. And that means that simply that debt's growing faster than the economy. By definition, that is unsustainable. There will be a point at which it becomes a problem of servicing the debt. We're not at that point. We're not close to that point. But we will need to get back where revenues and spending are better aligned. We don't need to pay the debt down. We just need to have the economy growing as fast or faster than the economy over a long period of time. And we must do that. I wouldn't say any particular level. There is no level that I can point to where there's a lot of science behind it being a problem. But we know that the path is not sustainable.
It's interesting that you allude to growth being part of the solution. I want to talk about regulation for a minute, particularly since the Biden administration delayed oil and gas lease sales again this week due to environmental protests. So if we pursued policies to increase American energy production by approving more leases and building more pipelines to transfer that energy and cut down on regulatory barriers to make it easier for folks to produce energy and produce anything, wouldn't that make a real impact on energy prices and inflation in general? without us needing to use the Fed to slow the economy with monetary policy to deal with inflation?
So these questions of the whole set of questions around energy are really questions for elected people. We don't have a mandate there. Obviously, the more supply there is, the price of something can go down. But these are trade-offs that you really have to weigh as elected officials, rather than.
I'll narrow it just for a minute. Do you believe that the vast amount of regulation is an impediment to economic growth?
I will say this, we try hard at the Fed to weigh the costs and benefits of regulation, and we do think it's important to think about it that way, because there are benefits to regulation, but there are costs, and we don't want the costs to be any higher than they need to be, because that does weigh on economic activity. Yes.
I mean, when you talk about somebody trying to buy a home and now they're questioning it because of the rise in mortgage rates, and then I hear for years that the 25% of the cost of a new home is due to regulation at some level. So that's the point I'm trying to make, is that we need to be very cautious with our regulations, because a lot of, it's constraining our growth, and the growth ultimately which solves this fiscal problem. So the point I'm trying to make is that we have much better tools like deregulation, which can free up supply, rather than just monetary policy. And freeing up supply could largely solve the inflation problem for hardworking Americans and not send us into a recession. So again, I thank you for being here, and Chairwoman, I yield back.
Thank you. The gentlewoman from Iowa, Mrs. Axney, who is also the Vice Chair of the Subcommittee on Housing, Community Development, and Insurance, is now recognized for 5 minutes.
Thank you, Chairwoman, and thank you, Chair Powell, for being here. It's good to see you. We've been talking inflation, of course. We know it's hurting Iowa families and families across the country, and all of us here have an absolute responsibility to address this. And I appreciate the comments of my colleague, Representative Himes, because I've sure heard a lot of talk about how bad inflation is from my colleagues over there on the other side of the aisle, but I sure haven't heard much about the solutions that they want to provide. So I'm here to work on those solutions, and I'm glad to have you here to talk with us about that. We actually need to reduce inflation, and we've got to figure out what's driving it. So the San Francisco Federal Reserve Bank just put out some research yesterday looking at how much inflation was driven by supply versus demand. What they found was that supply factors are responsible for more than half of the current level of inflation. And of course, I don't need to tell you that while prices increasing are hurting people across a heck of a lot of sectors, gas prices have really been driven up over the last few months. So, Chair Powell, on gas prices, could you talk about some of the supply constraints that have pushed gas and energy prices higher recently?
Sure. So, two big things would be, just one, the price of oil is set globally, and that's one. So we just take that price, and the second piece of it is the spread that refiners earn. So if refinery is at capacity and spreads are high, then you have a high spread there, and we know that the price of oil went up quite a bit. Started going up early in the year, and it's now come down a little bit in the last week or so. But those are the two things that have contributed to the spike in gas prices that we saw. We did see gas prices moving up, but they really moved up quite sharply beginning in the early parts of this year as the war came into focus.
Thank you. So you talked about, a couple of pieces where folks are making more money, and you talked about the refining process and that crack spread, and I think they're around $60 right now. So basically what's happening is they're making more money because supply is down. So would you agree that increasing the supply of gas could meaningfully lower prices?
I'd say it's hard to argue with that. Sure.
Okay. Well, the U.S. hasn't built a major refinery since 1977. So, of course, as we know, this isn't a recent issue. It's a long-term lack of investment. And so with so many parts of our economy, and you actually touched on that earlier. Now, here's the question I'd like to ask you. Will raising interest rates help increase supply here with fuel? And are there other economic tools to do that?
No, we can't have any effect on the price of oil or certainly the supply of energy. And the tools are in the hands; they're not in our hands.
Okay, thank you for pointing that out. So I know that the Fed absolutely wants to play a role in bringing inflation down, but I want to make sure that we are looking at those solutions and trying to understand what better tools we have. Are there better options out there that you could suggest right here?
Honestly, we're an agency with a narrow but important mandate and a set of tools, and our focus is on using our tools. We think there's a job to do on demand, and I don't see us giving advice to Congress or other agencies on how they might use their tools.
Okay, well, I appreciate that, and hopefully at some other time we can talk a little bit further about that. I want to move on to housing here as well. In the 2010s, we saw less homes built than each of the previous 4 decades, and we're more than 5 million homes short of where we should be. Boy, do I see that all over Iowa, in small towns in particular as well. I've talked to businesses that want to expand, but they can't do so because there are not enough houses there. And so housing is one of the most sensitive areas relative to interest rates. So I want to ask the same thing here. Will raising interest rates help supply there? And are there other tools that we should be looking at to do that?
So I would agree with you. There's a problem with longer-term housing supply and the difficulty of creating adequate housing. What our tools can do is they can, in the near term and medium term, they can restore a better balance between demand and supply in the housing market. You've had extraordinarily high housing price increases really across the country over the last couple of years, and that's because of a lot of demand and very low rates. And you're seeing the housing sector slow down to some extent because of higher mortgage rates now.
And so do you have anything that we should be on our radar or that we could be looking to do to assist with this?
I do think that these are issues for Congress around housing supply. If you talk to builders, and we do talk to builders, we had a group in last week, they will talk about the longer term issues, lack of supply of lots, lack of workers, lack of appropriate zoning and things like that. I mean, these are national issues.
Thank you.
Thank you so much.
The gentleman from Indiana, Mr. Hollingsworth, is now recognized for 5 minutes.
Morning, it's a pleasure to speak with you again. Before we get started on my questions, I just wanted to comment on Representative Axney's testimony or conversation or questions. I love the fact that she's beginning to recognize how heavy the regulatory burden has been in the refining space that has led to an underinvestment, and the Biden war on energy, especially on American-produced energy, continues to bear the fruit that they expected. And that is a deep concern for Americans that are paying more at the pump. We collectively find ourselves in the present situation because we fail to anticipate the future, even if that future is inherently uncertain and probabilistic. You said a few moments ago, we have a job to do on demand. I like that. And in the recent past and present, the policy signals, I feel like, have been unambiguous for the Fed. Inflation's at a 40-year high. The labor market is robust. Unemployment bouncing along multi-decade lows. Economic growth has been very high. But I worry that that lucidity is a luxury that is fleeting. I believe the future will be more ambiguous as we head into a time where economic growth seems to be approximately zero and labor market weakness is beginning to emerge. I think those policy signals will be less clear going forward. Economic growth in Q1 was negative, albeit for reasons I think you called technical in nature, but still negative nonetheless. Q2 economic growth is currently projected to be approximately zero according to the GDP Now tracker and many economists. Weakness in the labor market, while nascent, is beginning to emerge. Still yet, inflation as a lagging indicator remains, as you put earlier this week, very, very high. I've certainly praised the Fed's tardy yet sudden total focus on price stability, which will come, as you said, at the cost of aggregate demand reduction. Technical reasons or not, America will feel aggregate demand reduction where GDP growth is already zero as a recession. So I am curious to hear your thought process in an environment where inflation is steadying or coming down, but still yet at multiples of your target, and unemployment is escalating quickly and economic growth is negative. Tell me a little bit about how you'll think about that environment and approach that from a policy and rate setting perspective.
I guess I'd start by saying that that's not the environment we see or expect. We actually do think that growth this year, in the second half of this year, should still be fairly strong It is coming down from the very high reopening levels of last year, but the first quarter was somewhat anomalous. Private spending was actually at a very healthy
Tell me
level.
about how you'll think about that environment. I assume that you could be correct, but there's a chance you could be incorrect about that soft landing prediction.
So the way our tools work, what we're trying to achieve is, is to have a moderation in demand so that supply can catch up, and so that'll take pressure off of resource utilization, and inflation can come down. That's what we're trying to achieve.
But inflation will come down after that fact. Demand will come down first. Inflation will lag that, where inflation remains
That's right.
multiples of your target, but unemployment, because of that sagging demand, goes up. Economic growth is depressed because of that sagging demand. Tell me how you'll think about that environment.
So the way we think about it from a policy standpoint is of course, we raise interest rates and shrink the balance sheet. That affects broad financial conditions.
Indeed.
And that affects the economy. So the question we'll be asking is our policy rate, that's the thing we control, is it at the right level so that it's affecting financial conditions in the economy in the way that we need and intend? And
I want to know how you will intend to affect them where unemployment is going up and economic growth is negative, but inflation remains high.
Well, I think you would, in that hypothetical situation, I think you would say that would be a setting in which inflation could be expected to come down. As I've said, we'd like to see inflation coming down as well. Right. So the question is, you've got choices.
So you could move rates down or steady rate escalations in advance of inflation hitting your target, as long as you saw it beginning to come down, if economic conditions or your other mandate, full employment, begin to show weakness.
As one of my colleagues used to say, at every meeting, it's the same question. Do you raise, leave them the same, or bring them down, rates, right? So I think, I think we'd have to see what's happening. We'll try to make good judgments in real time. Right. But the main thing is we can't fail on this. We really have to get inflation down to 2%. So we're going to want to see evidence that it really is coming down before we declare any kind of victory. And so I think we'd be reluctant to cut.
Well, this will have real cost to Americans, so I want to make sure that we're forward thinking about what is going on in the real economy, not just watching a lagging indicator that is inflation. And with that, I'll yield back.
Thank you. The gentleman from New Jersey, Mr. Gottheimer, who is also the Vice Chair of the Subcommittee, National Security, International Development, and Monetary Policy, is now recognized for 5 minutes.
Thank you, Madam Chairwoman. Mr. Chairman, the most recent Consumer Price Index report indicated that the largest component of the CPI, shelter owned and rented, has increased 5.5% since last year. Estimates I've seen show apartment rental costs up 15% or more over the last year. Do you believe the CPI measure of shelter costs understates the actual increase in housing costs? And do you have any suggestions for actions Congress can take to lower housing costs for Americans in the short and long term?
There's some sense in which it might understate costs because it's not capturing leases that haven't turned over yet, right? So it's really looking at leases that are turning over.
So probably it's a higher rate.
Overall, we think it's a decent measure. It also remember that in the CPI, housing services has a weight that's double in the measure that we look at personal consumption expenditure inflation. We think that's a better, more sophisticated, a better representation of the inflation that's actually happening in people's lives. So we would tend to look at that.
Thank you, Mr. Chairman. I do want to shift to another issue that's covered in your June report. I've been engaged in discussions on cryptocurrency policy and have long warned that a run on stablecoin has the potential to stabilize financial markets. My concerns were realized in part last month when the so-called stablecoin terror collapsed. Your report highlighted the danger of that event and called for congressional action to protect consumers and financial markets. My draft legislation, the Stablecoin Innovation and Protection Act, would establish a definition and requirements for qualified stablecoin and define as cryptocurrencies redeemable one-to-one for U.S. dollars. This legislation would reduce financial instability in the markets and protect consumers and support innovation in fintech. It would create also a pathway for banks and non-banks to acquire qualified status for the stablecoins they issue. With federal oversight, do you believe non-bank entities can be reliable issuers of qualified stablecoins if they can prove they are fully backed by cash or cash equivalents?
So, as you know, we've recommended that Congress look at this, and there are many approaches, including yours. The President's Working Group did recommend that stablecoins be issued by insured depository institutions. I think it's great that Congress is looking at different approaches and evaluating those questions. What you really want, though, is you want to be sure that those entities are appropriately regulated, and in our view, in some sense, at the federal level. So, but I think it's That's going to be a question for Congress. You know what the PWG came up with, but I think there are different approaches.
Do you have any views on who the primary regulator should be at all? You think that's all up to Congress? Like, would the OCC would you have a problem with the OCC being a primary regulator?
You know, for national bank charters, yes, but I mean, the thing is, stable coins are used now principally in the capital markets, as you know, around the platforms, the digital finance platforms, and that's more in the bailiwick of the SEC. If there were going to be payment stable coins, we should be involved, and if it's going to be about banks getting involved, it'll be the banking regulator. So I think it's going to be, we're blessed by a plethora of regulatory agencies in the financial sector, so that'll need to be sorted out.
Do you think that's something, given the challenges we've had in the last months, that's something we have to move quickly on? Are you concerned with how long it's taking Congress to actually act there?
I think it's very important. It's no different than any other big technological innovation. Airplanes, for example, there comes a point at which a new regulatory framework is needed to protect the public and create, preserve innovation and competition, foster, support all that. But that time is coming for digital finance, and I think I'm encouraged that there are now a bunch of bills and proposals, and that Congress is working on this. I think it's important that it get done quickly, because as we've seen, these companies can grow really quickly, and we've also seen that they can have reverses as well.
And you think overall the ideal role of the Fed in overseeing stable coins is what? What ultimately you think long term, what's the role of the Fed?
Well, so the one question is around CBDCs, right? Is do we want a private stablecoin to wind up being the digital dollar? And I think the answer is no. If we're going to have a digital dollar, it should be done by us. We don't know that we need a digital dollar as such yet, but I think that it should be government guaranteed money, not private money that is really created for the benefit of the private issuer. So that's one thing. I think also we're very important in payments. So anything to do with payments that the public is involved in, we should be involved in that too.
Thank you so much. I yield back. Thank you.
Thank you very much. The gentleman from Tennessee, Mr. Rose, is now recognized for 5 minutes.
Thank you, Chairwoman Waters and Ranking Member McHenry, for holding the hearing today, and thank you, Chair Powell, for being here with us. A few moments ago, Mr. Himes noted that the American Recovery Plan, I think he meant American Rescue Plan, is not mentioned in the Monetary Policy Report. Chair Powell, is it Federal Reserve practice to comment on bills passed by Congress in the Monetary Policy Report?
No.
Turning to a question that we've obviously talked a lot about today already, you have inflation and rising prices on things like food and fuel are having a devastating impact on people all across Middle Tennessee and indeed across the country. You have told us that you will not comment on fiscal policy, but you have also previously urged Congress to support fiscal spending, some of which caused this inflation, in my view. Democrats are still pushing a reckless spending proposal, although reports are that it will be smaller than the one they tried to ram through Congress late last year. So, Chair Powell, will you commit to pushing back as strongly against reckless spending proposals that would exacerbate the current inflation as much as you push Congress to support more fiscal spending during the pandemic?
So I didn't support any particular bill, but I did say that there was more to be done. And I, by the way, I completely ended that practice at the end of 2020. Was it 20 or 21? Anyway, 2020. I completely stopped talking about that publicly at all. And the reason I did it before was, first of all, I was being encouraged by leadership on both sides of the hill in both parties. They were asking me for ideas. Don't you think we need to do something more? Can you help us? That kind of thing. But that's all done. That's over with. And the Fed should not play or seek to play a role in fiscal policy. We have our own mandate. We sure need to stick to that now.
In light of that statement, would you agree with this statement that the analysis that the Fed had through much of last year and that the administration to some extent continues to advance, the with respect to inflation and the policy prescriptions, has proven to be far more transitory than the inflation itself?
Well, if I understand your question, we did think that these were going to be passing forces. We thought that these shocks that were hitting, supply-side shocks, we thought they would be like oil shocks have been, where they come and go, and other supply-side shocks, commodity shocks of various kinds. As the course of 2021 went on, it became increasingly clear, particularly in the fall, that wasn't going to be the case. We weren't going to see that kind of progress, and we pivoted, 7 months ago now. We pivoted to address this with our policy tools. I think our judgment in real time proved to be incorrect, but it was not an irrational judgment, and it was one that was very widely held at the time by other central banks and economists generally. And but it wasn't about economics. It was, how long is this going to last? Are these things that are happening to our economy, which are unprecedented, are they going to get better? Like, for example, millions of people dropping out of the labor force, or the problems we have with the global supply chains. There was no model of that. We can't look at the last 20 times it happened. So that's, for sure, in hindsight, it was not transitory.
Thank you. The Committee for a Responsible Federal Budget estimated that canceling federal student loan debt held by Americans could increase the inflation rate as much as 0.5 percentage point and would add $1.6 trillion to the national debt. This estimate notably also did not incorporate the possible effect that student debt cancellation would have on increased college tuition prices. Chair Powell, has the Fed done any analysis on the inflationary impact of these proposals to forgive student loans being actively considered by congressional Democrats in the administration?
Not that I know of. We would look to CBO and legislation. We tend to start to put it in our models of the economy when we think there's really likely going to be legislation.
Generally, though, would you expect forgiving $1.6 trillion in debt, whether it's student loan debt or credit card debt, to have an inflationary impact?
Well, again, I'm going to leave that to CBO to score, and also the Office of Management and Budget. We just routinely do not score congressional proposals. It would get us involved in political things, and why would we be independent then? So to be independent, we need to be out of these very difficult fiscal issues, which are really your job.
Thank you, Chair Powell. I yield back.
Thank you. The gentlewoman from Massachusetts, Ms. Presley, is now recognized for 5 minutes.
Thank you, Madam Chair. Chairman Powell, without question, the Fed has a role to play in healing our economy. But as with any treatment, the wrong medication can cause even more harm and make the patient more ill. Chairman Powell, at your latest press conference, you stated, quote, "Wages are not principally responsible for the inflation we are seeing," end quote. I certainly agree with that assessment, as do many economists. Considering that wages are not driving inflation, why is the Fed addressing inflation with tools which primarily impact wages, such as interest rates?
Well, our tools principally impact inflation, not necessarily wage inflation. So our job is price inflation. But I will say on wage inflation, the issue is that over time, wages are really very important. Over time, looking forward, are very important, particularly for service companies where most of the costs are really in wages. And wages, we all love to see big wage increases, but these increases that have been having, some of them are just substantially bigger than would be consistent with 2% inflation.
Thank you. Well, throughout today's hearing, to that point, you've indicated that the Fed doesn't have more precise tools at your disposal. Chairman, the root causes of the inflation we are seeing are supply chain disruptions outside of the Fed's control, whether it's COVID-19 lockdowns in China or the Russia-Ukraine war, which is why this knee-jerk response to raise interest rates is so alarming. The Fed cannot control the factors causing inflation, but this policy choice would plunge millions of people back into unemployment, dampen wage growth, and tip the economy into a recession. There's an old adage, Chairman Powell, if all you have is a hammer, everything looks like a nail. You've recently said that the Fed's tools, like interest rates and the balance sheet, are famously blunt and lack precision. So in that case, do you agree that the Fed needs new tools that are more precise to better fulfill its statutory mandate of price stability and to maximize employment?
No, I don't think we're looking for new tools. I would just say that a big part of the inflation that's happening is really not going to be affected by tools, but a big part of it is going to be affected by our tools, and that's the part that's related to demand.
Mr. Chairman, but by your own account, you stated on the record that the Fed's current tools are ill-suited to deal with the inflation we are seeing. So perhaps now is the time to expand the Fed's toolkit to meet the unique moment that we find ourselves in. For example, one tool that could help the Fed tailor a more precise response to inflation is direct credit regulation. This would allow the Fed to regulate the availability of credit in the specific sectors of the economy experiencing high inflation without impacting other sectors. Would you support Congress passing legislation to give the Fed more precise tools to tackle inflation, such as this idea?
That's not something we would seek. Of course, it's up to Congress to make those decisions, though.
But at your own admission, your tools are too blunt and not precise enough. So what additional tools do you believe the Fed needs to respond more precisely to inflation?
Well, again, our tools they're blunt, but they are the right tools to deal with broad aggregate demand, and that is a more important determinant of inflation than energy and food prices. As painful as energy and food prices are, the bigger piece of it is related to demand. We can't help with energy and food prices, to your point, but we can help with aggregate demand, and we do that through the tools we have. We're not seeking a deeper involvement in the economy like you're talking about, but again, that's a question for Congress. Congress can change our toolkit or our mandate.
Well, in this moment of overlapping crises, from supply chain disruptions to high inflation, I do believe we need precise policies that respond to the needs of the American people. The Fed knows that raising interest rates will not address the root causes of rising prices, but they will just keep doing so, even at the cost of millions of working class people's livelihoods. We need a more sophisticated toolkit for the era we are in to truly heal our economy and tackle inflation responsibly. Thank you. I yield.
Thank you. The gentleman from Wisconsin, Mr. Stile, is now recognized for 5 minutes.
Thank you, Madam Chairwoman. Thank you for being here, Chair Powell. Appreciate it. Just a point of clarification. You noted that you ended your public statements in support of fiscal stimulus by the end of 2020. Is that correct?
Yes.
And so it'd be after that the Democrats, under one-party control, passed $1.9 trillion of additional fiscal stimulus. After it had already stopped making public statements in support of additional fiscal stimulus. I have the timeline correct?
Yeah, I mean, again,
I'm not asking you to opine. I just want to make sure I had the timeline correct.
I took no position publicly or privately, and neither should the Fed chair do so.
Understood, but your public statements in support of additional fiscal stimulus ended in 2020.
Yeah,
the Democrats, under one-party control, passed $1.9 trillion of fiscal stimulus after that period of time. I just want to make sure of the timeline. I understand. Let me cognizant of the time we have, and you've noted that you think the Fed should not play a role in fiscal policy. I have grave concerns of the fiscal policy that we've seen playing out in Washington, not asking you to opine on that. Looking at 2021, we saw real GDP growth about 5.6% in that year. Is that correct?
Yes.
Over 5%, a reasonably robust rate. At that period of time, in the year of 2021, we saw the Fed's balance sheet increase by about $1.5 trillion. Is that correct?
Sounds about right.
So at the period of time where we were seeing reasonably robust economic growth, the Federal Reserve was continuing to build its balance sheet to a tune of $1.5 trillion. And so during the year 2021, the Federal Reserve ultimately purchased about 54% of all federal debt issued by the Treasury. Is that accurate?
I don't know that. If you have the number in front of you.
I have the number in front of me. I think it's worthwhile. Roughly half of the federal debt that was issued in 2021 was acquired by the Fed and placed on the Federal Reserve's balance sheet. My concern is that that hid the real cost of borrowing that was being driven by the Biden administration at that time. And my concern is that the Federal Reserve, by increasing their balance sheet by $1.5 trillion at a period of time when Democrats put forward a gigantic stimulus package, after you had stopped your public calls for requesting additional fiscal stimulus, that's all part of the problem. It's both the fiscal policy and the monetary policy coming together. But let me keep going here for a moment. The federal government paid in debt payments last year $580 billion. Is that correct?
I don't know.
That's the numbers I have. It's about 5.8% of our budget, fiscal side. And the projections of CBO interest over the next decade, one of the CBO projects that it will triple to $1.2 trillion. But that's assuming federal debt remains in a range of 2.4% to 3.8%. That's the CBO's projections to get to debt payments increasing to $1.2 trillion by the end of the decade. But we're sitting here at a period of time when the 10-year Treasury yield has crossed 3%, 3.16%, I believe, as of yesterday. A year ago, that was 1.48%. So we're already approaching the high interest rate threshold that CBO has for interest on the debt to triple. Do you project that interest payments on the debt, the interest payment number that's impacted by the interest rate set by the Fed, will remain in a range of 2.4 to 3.8%, or do you believe that it will dramatically be above that?
We don't publish projections on on Treasury rates.
So as interest rates are moving, as you're doing that, I think appropriately so, to address the inflation environment that we're in, the Federal Reserve doesn't project the cost on the debt moving forward?
So internally, we don't publish, as what I said, but internally, we of course do have we have a path for the 10-year, for example, and for many, many years, it's always showed rates returning to levels even where we are or even higher. Well, that's what goes into our models, because we assume over time, for example, we're reversing, we're going to be shrinking our balance sheet by in the range of $1 trillion a year in coming years. So that'll put more supply out. That should put some upward pressure on rates. So we do. It's not our business to project this publicly, but that our assumptions are that rates will return to levels that are somewhat higher.
Well, let me for the record state that I'm very concerned that we're going to see interest rates remain high. The Committee for a Responsible Federal Budget notes that 50 basis points is $143 billion a year in debt. I'm concerned that we're on a path that's very unstable. Appreciate you being here. Madam Chairwoman, I'll yield back.
Thank you. The gentlewoman from New York, Ms. Ocasio-Cortez, is now recognized for 5 minutes.
Thank you so much, Madam Chair. And thank you, Chairman, for coming in to speak with us today. Chair Powell, in the summer of 2019, which admittedly was a different world, during a Financial Services Committee hearing, you relayed to me that, quote, I would look at today's unemployment as well within the range of plausible estimates of what the natural rate of unemployment is. Do you recall what the unemployment rate was around that time in 2019?
I want to say 3.5%.
Yes, it was 3.5%. And what is the current unemployment rate today?
3.6%.
3.6. You also said, quote, when unemployment went way up, you didn't see inflation go way down. So you don't see inflation reacting to unemployment the way it does because inflation seems very anchored. Again, that was at that time. Chair Powell, would you say that some, briefly yes or no, but would you say that some of the contributing factors to today's inflation include ongoing supply chain issues, including volatility of commodity prices as a result of the ongoing conflict in Ukraine, and companies also raising prices because they can?
Well, I would say on supply side issues, for sure, those are playing an important role.
And am I correct that American workers' wage gains have actually trailed inflation? In other words, while the cost of goods went up by 8.6% on average, wages did not increase by that much.
It depends. For some people at the lower end of the spectrum actually have been getting positive real wage gains. For most people, though, inflation has been higher than their wage increases.
So on average, we have a wage growth at about 6.1%. So average wages are trailing inflation. It does seem that American workers are not primarily responsible for the inflationary issues that we're seeing today. But despite this, we are seeing some comments from individuals like former U.S. Treasury Secretary Lawrence Summers earlier this year said that in order to contain inflation, the U.S. needs 5 years of unemployment above 5% or 1 year of 10% unemployment. Do you agree with that assessment?
So I understand how that number can be arrived at or derived, but I think there's so much uncertainty, and in particular, the answer is going to depend to a significant extent on what happens on the supply side. If we do get these supply side problems worked out, which I think is certainly going to happen in time, then you wouldn't see anything like that. But it's a highly uncertain time, and our intention, of course, is to bring down inflation while keeping the labor market strong.
I think it's important to drive home what a 10% sustained unemployment would look like in this country. For context, we didn't even reach 10% during the Great Recession. We did experience 10% unemployment in 1982 following the Volcker shock. But in this market, to get to 10% unemployment, that would require about 10.5 million additional people out of work. And historically, we know that black unemployment is usually double that of white unemployment, correct?
Yes, it tends to move at twice the speed, both up and down, but certainly moving up.
So when the former Treasury Secretary says he wants 10% unemployment overall, he's also saying that we need black unemployment of nearly 20%, or implies that. But Chair Powell, I do think that despite the tools that you don't have, Congress does have tools as well. Would you say that the following actions granted in the scope of Congress could be deployed to impact inflation, using antitrust laws against companies that are raising prices using their market power?
Sorry, I didn't hear the last part.
Would this action, would using antitrust laws against companies that are raising their prices have an impact on inflation?
Laws?
Antitrust?
Antitrust laws. Okay. Sorry.
No worries.
The acoustics in here are different.
No worries. Would that have an inflationary impact?
It's hard to say, really.
Would subjecting those companies to a windfall profits tax have a potential impact on inflation?
Again, I don't.
And would requiring government contractors to keep a lid on their pricing have certain impacts on inflation?
You know, there's a long history of price controls when inflation's been high, and it was not a successful one. Really, it comes down to getting demand and supply in alignment.
And if the Fed's tools mostly impact demand, but most of those inflationary issues could be potentially impacted by supply, how high do you think the Fed would actually have to drive unemployment to actually have an impact?
Well, that's going to depend on a lot of things, and you know, ideally we can raise rates, and it's very important that we get inflation back down, particularly for people at the margins of society who are suffering the most from inflation, and maybe a longer conversation we can have.
Thank you.
Thanks.
Thank you very much. The gentleman from South Carolina, Mr. Timmons, is now recognized for 5 minutes.
Thank you, Madam Chair, and thank you, Chairman Powell, for being with us today. Congratulations on being confirmed to your second term as chair. We got some rocky times ahead. Wish you luck. Last time you were here, we discussed how rising interest rates really inflates debt servicing costs for the federal government. And I know what you're going to say. That's a concern for fiscal policymakers, the Congress, to take into account, not the Fed. And that is mostly true. But I still think it's worth everyone being fully aware of just how costly servicing our debt will be now that interest rates are returning to historically normal levels. According to the CBO, interest payments on the debt are the fastest growing part of the federal budget. CBO projects that servicing our debt will cost taxpayers $8.1 trillion of the 10-year budget window, $8.1 trillion. And their inflation assumptions are projected interest rates are fairly lower than current levels and quite a bit lower than where rates are likely headed to get inflation under control. And I thank you for your efforts to get inflation under control, but for every half percentage point rate hike, that is an estimated $133 billion of annual increases. I'm going to say that again, $133 billion in annual increase in debt servicing costs. That is just a staggering amount of money. So we, Congress, must get our fiscal house in order. We have to. There is no other option. The dollar's position in the world as the global reserve currency is solid, and there are no immediate signs of that changing. But if we continue on our current trajectory, that will not always be a given. So my question is, are you worried that if our current fiscal path continues, which I should note with each rate hike it looks worse and worse, that the dollar's position in the world could be challenged in the long term? Is that a concern?
Certainly in the long term. The dollar is the reserve currency, and I don't see it as particularly under threat at the moment, given the advantages that we have, which are many. But you're right, the U.S. federal budget is on an unsustainable path, and we will have to deal with it. The sooner the better. And unsustainable just means that the debt is growing faster than the economy, which by definition, over time, can't be sustained.
Thank you. For the record, I also want to follow up. You stated the following as Congress considered the Biden stimulus. Quote, in addition, workers and households who struggle to find their place in the post-pandemic economy are likely to need continued support. The same is true for many small businesses that are likely to prosper again once the pandemic is behind us. That was from your speech on February 10th of 2021. I just wanted to add that in for the record. One final question. During a meeting last week at the International Association of Insurance Supervisors, the IAIS issued a consultation paper on comparability criteria looking at the use of international capital standard versus the aggregation method. As you know, the U.S. has committed to using an aggregation-like approach here in the U.S. through the National Association of Insurance Commissioners Group capita calculation and the Fed's proposed building block approach. Moreover, the EU and the UK, through their covered agreements with the US, recognize these approaches to group capital. Nevertheless, Insurance Europe, a federation of European insurers representing more than 95% of the European market, takes the view that there cannot be two versions of an international capital standard. So my question to you is this: will you continue to advocate and support the aggregation method as an alternative to the international capital standard?
So I think I'm a little rusty on that, but I will say this. I know that we're strongly committed to capital standards that work for U.S. insurance companies.
I get that, but I guess what I'm getting at is we have a different way of regulating insurance here in the U.S. We all know that, and it works for us, and we do not need to let these international bodies change our way of doing things. We need you to stand up for the American way of doing things and for American businesses. Can you commit to doing that?
So I think that's what we're doing. So
okay.
Yes.
Thank you. Madam Chair, I yield back.
Thank you. The gentleman from Massachusetts, Mr. Auchincloss, is now recognized for 5 minutes.
Thank you, Madam Chair. Welcome, Chairman. I want to start by asking you about inflation expectations, which, as you obviously well know, can be very difficult to dislodge once they are anchored in the mindset of consumers, and what the Fed can do both to address inflation, but also to convince Americans that inflation is going to be lowering in the medium term and thereby prevent inflation expectations from getting anchored.
Well, so if you look at inflation expectations, and of course we measure professional forecasters, households, market-based break-evens and things like that, a broad range of things, you do see that people expect inflation to be high in the very near term, but they expect it to come down fairly quickly and get back to. So generally, as a general matter, the evidence is clear that people do expect inflation to come back down to levels that are consistent with our price stability mandate. But this is the first, we haven't had a test like this. I would say we haven't had an extended period of high inflation for a long time, and so it's not a comfortable place to be. Short-term inflation expectations are higher, and it does add, it adds to our desire to move expeditiously and with force to get rates up and ultimately to get inflation down.
So, building on that, 1 degree removed, the only thing more painful than expected high inflation is unexpected high inflation, and it makes it the degree to which businesses and consumers do not have confidence in the Fed's ability to control inflation or the U.S. government at large, makes it harder for them to make capital investments in the long term, makes it harder to do wage negotiations. Is there a measure of the degree of confidence that both business and consumers have in the ability of inflation to remain low that you are tracking, so that we can try to measure the degree of confidence people have in not having to see unexpected inflation in the future?
So first, I agree. But ultimately, this is the point is that if the public retains confidence that inflation will come down, that their expectations remain anchored, then it will come down. That is we think that's how
self-fulfilling,
right? So by many measures, we track them all. I mean, we put them all in one big measure called the Index of Common Inflation Expectations. We do that and we publish that at various times. And they're sending basically that message that essentially, yes, inflation expectations are anchored. But as I said, that's good, but it's not enough. We need to get inflation down because inevitably over time, these expectations are going to be under pressure.
Are you able to track, though, it seems like you also want to track volatility within that index of inflation expectations to see how much confidence people have that they're not going to see unexpected inflation?
Yes. We look at the distribution, and there's some small signs, concerning signs, and we just can't allow that. We really have to. Ultimately, our whole framework is about keeping inflation expectations well and truly anchored, so that inflation will return to that anchor.
And your credibility in that is autocatalytic in inflation expectations. So I think it's critical that the businesses and consumers have that confidence.
Absolutely.
Can you explain how quantitative tightening, I guess we would call it now, is going to play into that? Unrolling quantitative easing of the last 10 years?
Sure. So it's quantitative easing in reverse. So what quantitative easing does is it reduces the supply of risk-free, longer-term assets, and that tends to drive rates down as people want those. And when we loosen our balance sheet, when we shrink our balance sheet, what happens is the public will be holding more of that paper and we won't be holding it, and that should have some upward pressure over time. Markets are forward-looking, so they're already pricing this in.
And you don't project any changes in how you're going to do QT?
So we put out a plan. We thought very carefully about it. We've announced it. Markets have seen it, and it's sort of priced in. And I think we would intend to keep to that plan. Of course, one of our principles is that we're always going to be flexible if that's warranted.
Last question for you in the final 30 seconds here, Chairman. Can you give us an update on FedNow and your plans for access both to established banks as well as to financial technology companies?
So FedNow is supposed to go live next year. We believe we're on track to do that. We've got people working really hard on it for some time. I didn't catch the last part of the question.
And how are you going to make access available? Is it going to be just for certain types of banks? Is it going to be for financial technology companies? How are you going to adjudicate access?
So that's something we're looking at. We are, mainly it's for the broad sweep of banks, and we'll have to look at going beyond that.
I yield back.
Thank you. The gentleman from South Carolina, Mr. Norman, is now recognized for 5 minutes.
Thank you, Chairwoman Waters. Chairman, welcome. Glad to have you here. Would you agree that housing is a leading economic indicator on the health of the economy or on the direction the economy is going?
It's certainly an important indicator.
Because it affects so many different facets of the economy. Because it affects so many facets of the economy, is that right?
I'm sorry, I'm having a hard time hearing.
Because it affects so many facets of the economy. In other words, when you housing, whether it's commercial or residential, you buy a lot of products that are across the spectrum.
It's an important, very important sector of the economy for the reasons you point out.
And one of the reasons that most economists are predicting a severe recession is housing as a leading economic indicator. I've done that. That's what I've made my living. Do you realize it's very simple to solve to get the housing at a point that it was under the previous administration? I'm from South Carolina. People are moving there. Do you realize in the last probably 4 months, it's been a severe cutback, despite the fact that people are coming in and need it. And it's because of this administration's war on energy and natural gas. The Fed can't regulate that. Putin can't regulate that. It's a direct result of policies of this administration. And one of the reasons that it's basically going to come to a standstill, the war on energy, you can't afford gas for your product. It's a war on the workforce that this administration has done. When you pay people not to work, it's kind of a disincentive to go to work. Supply chain that has been mentioned, when the call I got 4 days ago, a leading producer of chicken cannot get corn to feed the poults, the young chickens, is kind of a problem. Interest rates, which is at your disposal, is severely going to affect the housing industry. When you're paying a 6% long-term mortgage rate, along with every other cost increase directly caused by the policies of this administration, the housing is going to come to a stopping point, as it is now likely to have. Regulations have been mentioned here. We now face on simple projects regulations, and I would point out many of them needless to be 35, 38%. When you combine all of these things, housing is going to take a tremendous drop. That will affect the economy, wouldn't you say?
I think all of those things are affecting the economy.
Is greed that has been mentioned here a leading cause of inflation?
I think it's a macroeconomic phenomenon that's caused by the things we've been talking about.
Was greed not a factor 4 years ago? I mean, if it's a factor now, were they just less greedy in 16 through 20?
It's hard to see why there would have been.
Right. And was he responsible for the low gas prices that we experienced from 16 and 20?
Not as far as I know.
I don't think he had much impact. If he did, it'd be a sad state for the United States. I think one of the congressmen mentioned about the debt relief of college students that's been proposed by the current administration. How will that have an effect on the economy? And I think the number that's been talked about to forgive $50,000 per student, will that affect the inflation and the economy?
As I mentioned, we don't score these bills from an inflation standpoint.
It wouldn't be positive, though, would it?
Sorry?
I doubt it would be positive, would it?
Well, I don't know. I mean, that's for elected folks.
All right, and on the central bank digital currency, would you have to have approval from Congress before the Federal Reserve got involved?
I can't imagine that we would move forward without authorizing legislation.
So you'd have to have the approval of Congress.
Yeah. Yes.
Well, thank you for what you're doing. You're using the tools that you have at your disposal. Most of this can be eliminated if we had a policy now that was pro-business, pro-growth. But thank you for what you're doing, and congratulations on being reappointed as chairman.
Thank you.
Thank you. The gentleman from California, Mr. Vargas, is now recognized for 5 minutes.
Thank you I'm over here, Mr. Chairman. Thank you very much, Madam Chair and Ranking Member. Mr. Chairman, thank you very much for being here, and congratulations, I think. I'm not sure. You're running into pretty heavy lift here going forward, but very much I appreciate you being here today. I believe that inflation is real, obviously, and it's hurting a lot of people. It's the causes, I think, that are being manipulated and frankly lied about. And there's one big criticism that I make of you, and also, and especially, I guess, Secretary Yeltsin, and that is that you haven't explained inflation within the context of the world environment, what's happening globally. My good friends on the other side of the aisle love to blame inflation singularly on President Biden and his policies. I didn't get a chance to ask Secretary Yellen any questions when she was here last time, kind of low on the totem pole here. But I wanted to scream because every time she led with her chin as opposed to explaining that this inflation is globally. But now that I have you here, I get to ask you some questions. What is the inflation rate in the European Union?
Overall, I wouldn't put
It's
a number.
8.8% according to Statistica. Did they receive any money from the American Rescue Plan?
Not to my knowledge.
What is the inflation rate in Estonia?
In Estonia, don't know. I mean, they're roughly comparable to ours.
It's 20.1%. It's not very comparable to ours. It's over 3 times higher than
Big
ours.
European democracies.
Estonia. Did they receive any money from the American Rescue Plan?
Not to my knowledge.
How about Latvia? What is the inflation rate in Latvia?
No idea.
It's 16.8%. Did they receive any money from Biden or the American Rescue Plan?
Not as far as I know.
How about Bulgaria? 13.4.
I knew that one.
Poland, you knew that one?
No.
Oh, I apologize. I'll let you try with Poland. How about that? They're a friendly nation. 12.8. Did they receive any money from the American Rescue Plan? And if they didn't, why do they have inflation that's so high?
Not as far as I know.
So why is their inflation rate so high?
Well, in Europe, the inflation that they're seeing is principally, I believe, due to energy prices and food prices. It's due to the war, and it's due to, the situation with Russia being their principal energy supplier.
So not the American Rescue, they didn't receive any money, though, from the American Rescue Plan?
Not as far as I know.
Okay, let's keep going. Romania, 12.4. Slovakia, 11.8. Hungary, 10.8. Croatia, 10.7. Greece, 10.5. The Netherlands, come on. You ought to know the Netherlands.
I sense that we're going down, so be lower.
10.2.
See?
But you do see I'm glad that this is going. Germany, how about, let's skip to Germany. Very similar to us.
I'm not going to guess.
8.7. And the reason I wanted to go through the litany of these things, I keep hearing from my good friends on the other side of the aisle that inflation somehow magically exists because of Biden's policies, because of the American Rescue Plan. Well, if that's true, then there shouldn't be this other inflation in other countries. It's a global phenomenon. As Clinton used to say, it's the economy, stupid. Here it's the pandemic, obviously, and things that happen. We have a situation around the whole world, yet you don't explain it globally. And I shouldn't yell at you because I really like you a lot, and I really do think you're doing a good job. I'm trying very hard. But I did want to yell at Yeltsin because she didn't explain anything globally. Don't you think you have a responsibility to the American people? I know in my district, most people believe that inflation's only happening here because of the rhetoric that they hear on the other side. And you guys, I think, have the opportunity and the responsibility to give them the full picture, not this limited picture. And I hope you do so. Again, with that, I'll yield back. Thank you very much, Madam Chair.
The gentleman yields back. The gentleman from Oklahoma, Mr. Lucas, is now recognized for 5 minutes.
Thank you, Madam Chair. And actually, I think my timing for my question is perfect. Chairman Powell, I'd like to discuss with you today an issue that is of significant concern to me and many of my colleagues. The SEC's regulatory agenda has more than 50 significant proposals that are currently underway or approaching a final vote. These rules cut across every asset class under the SEC, the Securities and Exchange Commission's jurisdiction. The sheer complexity and volume of these overlapping rulemakings could negatively impact markets and the public that depends on them. SEC Commissioner Hester Peirce, warned that the speed and character of these rulemakings could create dangerous conditions in our capital markets. Now, this is against a backdrop of the U.S. economy facing significant challenges. We've discussed that all morning. Inflation at more than a 40-year high with substantial increases in the cost of food, housing, and gas prices at record prices. Also, supply chain backlogs and labor shortages continue to weigh on the economy with consumer and business confidence plummeting. And of course, we're still studying the impact of the global pandemic and the consequences of the ongoing Russian invasion of the Ukraine. In Oklahoma, small businesses, farmers, ranchers are navigating through surging energy prices and volatile agricultural markets for inputs like grain and fertilizer. Poor crop conditions and high commodity prices are expected to worsen the situations throughout the summer and into the rest of the year. In uncertain times like this, market participants need to seek to protect their retirement savings, to hedge risk, and to safeguard their livelihoods. A top priority should be supporting liquid markets to protect the U.S. economy from the face of these substantial headwinds. I know you don't comment on other entities within the federal government. I know these regulations that are going to have such a tremendous impact are not coming from your area, but unfortunately I'm concerned that the magnitude and the significance of rule-making proposals coming out of the SEC in such a short amount of time runs counter to the goal. We know that regulatory uncertainty creates adverse market environment for economic growth and market stability. So Chairman Powell, I'll not ask you to comment on the SEC, but could you speak to the importance of market liquidity during periods of economic uncertainty?
Yes, so markets are there to, one of the things they do is process information and consider the implications of it, and it's critical that markets be liquid enough to do that. And if that happens, then financial conditions can adjust and equity prices of various kinds can adjust. And that's one of their big functions, is to do that and to absorb news, sometimes very difficult news, in a way that preserves stability.
I think Congress and the public should have the opportunity to fully grasp the impact of the SEC sweeping proposals. If we really want to tame inflation, we should begin by not making the current situation worse. The SEC's approach will rattle markets during a time when strong capital markets are essential to our economic growth and our constituents back home. After all, you're working hard on the demand side of the equation, but we in Congress and the administration should help with the supply side of the equation. And that is not making it more difficult to invest in and create more goods and services in this country. That said, Chairman Powell, as you've acknowledged, the Fed's monetary policy tools can do very little to mitigate rising gas prices. However, the increased cost of gas has an oversized impact on consumer inflation expectations. Folks see the price at the pump going up and experience the price per gallon at an all-time high. Could you discuss how the Fed envisions its ability to rein in inflation expectations, driven in large part by gas prices? Or put another way, if gas prices remain at record levels, is an aggressive response from the Fed all but guaranteed?
Well, if gas prices remain at the current levels they're at, then inflation, the problem is inflation means continuing to go up. So it isn't so much the level as the rate of change, as you know. So I think we are mindful that even though these things are outside of our control, the gas prices and food prices for the most part, that adds a little bit of urgency in our wanting to get our rates into a place where we're addressing inflation directly, because the public reacts to all kinds of inflation, not just core inflation. Our tools generally go to core inflation. So, we don't think we can use our tools to change energy prices, but we do think that they add to our desire to get expeditiously to the appropriate levels.
And clearly, Congress and the administration, the majority, has a responsibility to increase supplies of resources, not discourage that. Yield back, Madam Chair. Thank you, Mr. Chairman.
Gentleman's time has expired. The gentlewoman from Ohio, Ms. Beatty, who is also the chair of the Subcommittee on Diversity and Inclusion, is now recognized for 5 minutes.
Thank you so much, Madam Chair, and thank you, Chair Powell, for being here as you're navigating through all these federal issues during this difficult economic time. Chair Powell, after our hearing concludes, this committee will be voting on a few pieces of legislation, so I'm going to take advantage of having you here to shed some light on a few of the things that we will be considering. I can't think of a better person to give us some insight on these issues. First question is, we'll be voting on an amendment that would delay the SEC's small business advocate from conducting outreach to underserved business owners until after gas prices drop to the pre-COVID level. Chair Powell, in your opinion, will delaying the SEC's outreach to minority business owners affect gas prices in any way?
I'm, with all respect, I'm reluctant to comment on proposed legislation.
Well, let me ask it this. Let's say if it's not legislation, is there a correlation between what gas prices would be in relation to what they were with pre-COVID with inflation?
Again, I'd be expressing an opinion on someone's amendment, and if I start down that road, I don't know where it stops. I really, these are matters for elected people.
Well, would you say that the global markets and inflation is across the country, that we're seeing this everywhere?
Yes, inflation is happening everywhere now.
I'm dealing with a lot of fair housing issues in my district. And, I have a long history of working with public housing and relocating people. And as we look at issues with housing, do you think housing is any way tied to inflation?
I'm sorry, I didn't catch the question. I apologize.
Do you think what's happening in our housing market is tied to inflation in any way?
Yes, it is. Yes. So housing costs are about a third of the CPI. Housing, we call them housing services, and that's really rents plus the way it works is in effect an owner of a house is charging something called owner's equivalent rent, or paying something called owner's equivalent rent. So yes, it's an important factor in inflation.
Okay, so can you tell us, in your opinion, in light of Congressman Vargas's question, as he was giving us an idea of, as some of our colleagues are trying to tie things to the American Rescue Plan, they're trying to tie it to us taking care of the least of us, that if it is tied to inflation, why in other areas or countries and they don't have the American Rescue Plan? And how do you answer more about Mr. Vargas's question? I mean, I know he gave you a litany. I'm not trying to put you on the spot with quizzing you on what their inflation rate is in comparison to ours, but I think you got where he was going with this. Is there anything else you'd like to elaborate on in relationship to where he was going?
Sure. So I'll just say these things there are differences between, even though we have a very similar inflation rate with a lot of the large European democracies now, pretty close. There are differences between countries, and the difference with the U.S. Compared to the European countries is that ours is more about demand. We have areas in our economy where demand is substantially in excess of supply. That's not mainly a feature of the European economies, where they're really feeling, very, very high inflation because of energy prices and also food prices now. That's part of our story too. We're also feeling energy and food prices, but we have this other part that is more core inflation, that is more susceptible to being managed by our tools, and is really the object of our tools.
My time is already up, but in light of your response to my first question, I just need to say for the record, I can't conceive of a single connection between gas prices set by global markets and giving advice to small businesses. And the same, I have a hard time coming up with a theory of how allowing discriminatory housing will help stem inflation. And I think my time is up. I yield back.
Gentlewoman's time has expired. The gentleman from Texas, Mr. Session, is now recognized for 5 minutes.
Thank you very much, Chairman. Chairman Powell, thank you very much for taking time to be with us. This is important to the American people who hear our questions. This is important for us as we weigh and measure and gauge your input, which we believe is exceptional. I've stated that to you in the past, that I believe that we need to have confidence in what you're doing. Today, I'd like to, if I can, without dissecting your thinking, use some of the words that you have provided for us today to see your thinking. You had stated that as it relates to the Fed, quote, "We don't give advice to agencies." Now, that's a quote from you today. We don't give advice to agencies. Do you think that advice is different, which I do, than tools which you have to do your job? But I consider part of what you do best, perhaps the Fed, is advice. Can you help me to understand we don't give advice to agencies?
Well, so I think particularly on fiscal matters, fiscal matters affect people's lives. It affects industries and people and tax levels and spending. That in our system is the province of elected people. And, for someone who's an appointed person who hasn't stood for election and has a very narrow mandate, I just think that's not appropriate. If we're going to wander into those kinds of things, then what would be the case for our independence? If we're going to be involved in every political issue that isn't directly connected to our work, then why would we be independent? We should just be another agency. But we have this independence, and I think to preserve it, we need to stick to what we do and resist the temptation to work on every problem, even the ones that are not assigned to us.
Well, let me say thank you for the answer. You do know, however, as we were talking about student loans, it's a rather large amount, about $1.2 trillion that is out there. You stated that you believe that would likely be dealt with in legislation. Now, that's what you said, likely to be dealt with in legislation, student debt. I think even private advice, not within your tool structure, but this advice that we're trying to land on, would be really important, because it will be, the way I see it, the next large hit to inflation. And this is why Republicans, or at least this Republican, says that I believe that this administration, the Democratic Party, are making friends with inflation. They are using the toolbox that they have of politics and money and spending policies to make friends with inflation. So my point would be to you, I sure hope that someone could send an unnamed memo to someone saying that you have an opinion, if you have an opinion on that. Next point, we have had some discussions about unemployment. How is unemployment calculated?
So you have to be actively looking for work within the last month to be and not have a job to be unemployed. If you're not looking, then you're out of the labor force, and that's so you're not participating in the labor force. So those are the factors.
So what we want to do, some members of this committee have wanted to look back and to say, well, perhaps under President Trump it was 3.5%. Now we're 3.6%, so not a big difference. And yet the huge number of jobs that are available is really the factor. When there are not jobs, that is a problem. But to simply say, well, Trump was 3.5, now we're 3.6, everything is fair, it's all done. I think the other advice I'd love to have you have from the Fed is to someone about getting people back to work. Because today, the government has given zero instructions for federal workers to return to work. And I think that it is causing a mindset among many, we don't need to go to work, thus reflected in 3.6% unemployment and millions of jobs awaiting. Mr. Chairman, thank you for taking time to be here. It's my hope that you would find in your toolkit advice that becomes perhaps more important, and I thank you, sir.
The gentleman's time has expired. The gentleman from Florida, Mr. Lawson, is now recognized for 5 minutes.
Madam Chair, can you hear me?
Yes, sir, we're loud and clear, and we can see you.
Okay, thank you. Okay, I want to thank Mr. Powell and welcome him back to the committee. I know it's a great deal that is going on. And Mr. Powell, I think earlier there might have been something that came from one another of my colleagues, and it was a rise in interest rate to combat inflation does come with a rise in unemployment rate and possibly contributing to an economic recession. While white unemployment rates have dropped to pre-pandemic levels of 3%, and in QI 2022, the national black unemployment rate remains still at 6.5%. And I know something you can't say, but what suggestion can you offer to help prevent Black and other minority communities from facing future economic inequities as the Federal Reserve continue to raise rates in the near future?
If I heard your question correctly, it was whether we're considering additional future interest rate increases, sir?
That's correct.
Yes. So I think just last week, my colleagues and I wrote down our forecast for this year, and we anticipate ongoing rate increases over the course of this year. Yes, additional rate increases.
Powell, do you believe that the Fed's current inflation projection of 2022 and 23 remains a good benchmark to consider, even with these vulnerability potentials growing in the upcoming months?
I think these are the projections the latest projections that individual FOMC participants submitted were submitted last Wednesday. So I think they're still fresh, and there's a range of expectations of people on the committee, but I think they're a reasonable set of projections. Yes.
Okay. And Mr. Powell, several of my colleagues on the other side of the aisle have been debating about the Biden policy and so forth, which I know you can comment on. But there is a concern where we were kind of caught off guard with the war in Ukraine, and then at the same time, our vulnerability of all of the things that we depend on for other countries. In your deliberation, when you all are working with the situation that has arrived, that came from the Russia-Ukraine war and other real estate and other stress in China spilling over into the United States, does the Feds give a recommendation back to the administration on how we should proceed in the future? Because everything, we've done a lot of things with other countries and depend on a lot of countries for resources and so forth. And it looks like we're becoming very, very vulnerable. Well, it doesn't look like it. We're becoming very vulnerable to this dependability. Do you all make a recommendation back to the administration on how we should proceed in the future?
No, sir, we do not.
Okay, and so early on you said that it's prominent that policy position should be considered by the legislature or the administration. Am I correct?
I'm sorry, I lost track of what you said there. I apologize.
I think to some other colleague of mine, you stated that those policies should be left up to the Congress or to the administration. You all don't really deal with that aspect of it. Am I correct?
I'm sorry, which aspect of it?
About what recommendation could be made for all of the things that we have offshore that we depend on from other countries. Yeah. And I might not be really clear, but for example, like the gas situation with Russia, and wheat and stuff with Ukraine and stuff of this nature.
No, we're not in those discussions. Those are really discussions that happen inside the administration, the Treasury Department and the White House and the other agencies.
Okay. With that, Madam Chair, I yield back.
Gentleman yields back. The gentleman from Missouri, Mr. Luckenheimer, is now recognized for 5 minutes.
Thank you, Madam Chair, and welcome, Jerome Powell. Long morning for you here, and afternoon. Question for you with regards to a quote that on March 17th, the CFPB put out in a blog on rising interest rates, in which they said, and I quote, "The CFPB is the arm of the Federal Reserve System that is fully focused on consumers, ensuring that markets are fair, transparent, and competitive," end quote. Do you believe the CFPB is an arm of the Federal Reserve? And do you have any control over their actions?
Well, they're an independent agency. We have no control whatsoever of their actions. They are actually, though, legally a bureau. The law makes them a bureau, and the profits that we make off of our balance sheet, we give all of them to the Treasury Department, except the part that we give to pay for the CFPB.
So does that make them an arm?
For all practical purposes, they're fully independent in all of their policies.
They're not an arm of the Federal Reserve, then? I wouldn't consider that an arm. They have a relationship, but they're not an arm.
Technically, they're a bureau, but
they're not under you, so they're not. I don't know how they could be.
No,
an
we
arm.
have no supervision.
Okay.
And, we collaborate with them, we coordinate with them, we talk to them.
Well, this is overreach by the director. I just want to make sure that everybody's on the same page. This is a bunch of nonsense, so it needs to be put in its place. Chairman, you've got your hands full right now. This is Wall Street Journal from Tuesday. We had economists say recession is likely. Down here, we said stocks are not bottoming very soon. So we've got some concerns. I know yesterday you were in the Senate, and there was a lengthy discussion on inflation, which there has been here this morning as well. And in my mind, there's 4 root causes of inflation. And we've had economists in your chair a few weeks ago, and I had one in my Small Business Committee a couple weeks before that, and I asked the same question of them. I said, it looks to me like there's 4 causes of inflation: monetary supply, rules and regulations, energy, and supply chain / job problems that we have with workers in the economy today. And they both agreed that's basically your 4 problems that are underpinning inflation. I asked them to give me a percentage on each one of them. They said roughly 40% for money supply, 20. So I guess my concern is that, if you look at those 4 causes, you're trying to help fight inflation. It's one of your mandates. And you really, under money supply, is the only thing you have any ability to do something with. And even then, it's probably only half of it, because Congress has control over how many dollars are put into the system with additional bills, like the $1 trillion stimulus package from last year, taxes and things like that. So it looks like you have a minimal amount of impact out of those 4 things. So it looks to me quite oftentimes whenever you're trying to control the inflationary stuff with the interest rate, it's kind of over here trying to do a little something, when over here there's all sorts of stuff going on, and the administration seems to be in contradiction to some of the things you're trying to accomplish over. Do you ever feel like that? Do you believe that may be a position that you're in right now?
So we're very focused on the part of the job that we can do and using our tools to do it.
Well, I understand that, Mr. Chairman, but I would seem that it would think that you're, all these other factors fall outside your purview here, and for you to try and manipulate it, and everybody rely on you to solve the inflation problem by tinkering with the interest rate over here, it looks like that's a little overhyping the situation. But one of the things that is very concerning is the regulatory cost. In my discussion with the economist, he said, look, and this is the administration's own figures, last year, Biden administration the cost of compliance with new regulations was $201 billion. That's astronomical. That's a huge cost that has to be built into all the small businesses and other businesses whenever they produce products and services for sale for customers. They've got to build in an additional $200 billion in costs every year. Would you agree that's a huge driver of inflation?
It sounds like a big number, yeah. And as you know, we try at the Fed to weigh costs and benefits and take that into consideration.
Would you agree that those other 4 things that I said are underpinning inflation, would you agree that those probably are the 4 major problems?
Yeah, so overwhelmingly, most economists would not think of it in terms of money supply, but would think of it in terms of supply and demand. And although there may be a role for money supply. They would think in terms of supply and demand being
Well-
out of balance, and that's
Well,
how I think about it.
You know, the definition of inflation I've always had was too many dollars chasing too few goods and services. If you throw more money in, you have more money to supply to the consumers.
There's 40 plus years of history and actually Milton Friedman at the end came back and said, that's not really working anymore.
Mr. Chairman, I just
It
got
may be
one
working
more.
again, though.
One more quick comment for you with regards to this. It looks to me like whenever you're
Gentleman's
modeling,
time has expired.
when you're trying to
Gentleman's
model
time
and
has
you use these
expired.
4 different things, I hope that your
Gentleman's
models
time
are
has
including these
expired.
things in your modeling. I appreciate just a 13
Gentleman's
seconds to
time
be able to
has
finish my
expired.
question. Thank you, Madam Chair.
Absolutely, thank you. Gentleman from California, Mr. Chairman, who is also the chair of the Subcommittee on Investor Protection, Entrepreneurship, and Capital Markets, is now recognized for 5 minutes.
Chairman Powell, I want to thank you for bringing to the attention of this committee over the last several years the systemic risk posed by tough legacy LIBOR, some $16 trillion of instruments where we would not know the interest rate that the debtor is supposed to pay the creditor, and $16 trillion is a big problem. We passed the relevant bill back in March, and for those who think Congress can't possibly deal with a problem until after the last minute, we passed it a year and a half before the LIBOR hit the fan. That bill requires rulemaking by the Fed, and the rulemaking is supposed to be done by mid-September. And that would put us in that's the final step in making sure that these LIBOR instruments are not a subject of uncertainty, because even 1 basis point, 1/1000th of a percentage point of risk or uncertainty, turns out to be significant when you're dealing with $16 trillion. So Chairman Powell, can we count on the Fed in getting these regulations out by mid-September?
Yeah, so by the way, thank you for all of your efforts on this technical problem, which have really helped move it along. And in terms of the rule, yes, we know the deadline. We know it's a tight deadline, and I'm assured that people are working very hard to meet that deadline.
Thank you. You're shrinking your balance sheet. A lot of focus on how much you're shrinking your balance sheet, but it also, what matters is the content of the balance sheet. You can invest in treasuries, or you can invest in mortgage-backed securities. If you go to an all-treasury portfolio and sell off your mortgage-backed securities, that'll probably raise mortgage rates. And we're trying to deal with housing inflation and housing affordability. So whether it's the mortgage on an apartment building that might be built, or whether it's a home mortgage, keeping mortgage rates low, I would think would help inflation. Is there any possibility that you would take a look at that and perhaps keep in your portfolio some of your mortgage-backed securities and perhaps have a mix of mortgage-backed securities and treasuries in your balance sheet?
So we're committed to having a mostly Treasury, not all, but mostly Treasury balance sheet. And we don't have that now. And Treasuries are going to start to roll off, mortgages much less so. We have not decided to start selling mortgage-backed securities, but we've said that we'll look at that again when this process is further along. And if we do, I don't actually think that the things we would do would have much of an effect on mortgage rates compared to, the effects that we've already had.
We have obviously faced a recession risk. Biden says that a recession is not inevitable. Do you agree?
I don't think that a recession is inevitable.
Thank you. There seems to be a great debate in this committee as to whether inflation is the result of COVID and the effects of the Ukraine war, which affect the entire globe, or whether they are the result of Biden and his policies, which, believe it or not, are not applicable to Germany, Britain, or Canada, as much as we in the America like to think that we are the entire world. And then we look at inflation rates, and we see higher month-to-month inflation rates in Canada and Germany than here in the United States, higher year-on-year in Germany and the UK. So we're in a situation where only if you believe that Biden is responsible for German inflation can you reach the conclusion that it's Biden's policies that have caused inflation in the United States, which is pretty much on a par with what we see in other developed countries, particularly Europe. A part of this is the idea that if Biden just gives a speech saying we'd like to see a fossil-free future, that somehow impairs the amount of oil that is produced in the United States and somehow then affects worldwide oil prices. I would put into the record this article from Forbes titled, U.S. oil companies have increased drilling by 60% in 1 year. And without objection, I hope that could be done.
Without objection.
And I would point out that we had higher oil production in this country in the first year of Biden than the last year of Trump. Then we had higher oil production in 2022 than 2021. And in 2023, we will have the highest oil production in the United States in our history. Unfortunately, that'll probably not be the lowest gas prices in our history. So whether it's good or bad, we've discovered that making speeches does not suppress oil
Gentleman's time has
production.
expired.
I yield back.
The gentleman from Michigan, Mr. Huizinga, is now recognized for 5 minutes.
Thank you, Madam Chair. And it's just so ironic that, that my colleague is talking about oil and pumping. I literally just left my office with a group of folks from Alberta. There is an alliance of 6 energy companies up there that are going to get, by the way, to net zero on their carbon emissions by 2050. But Canada supplies 62% of all the oil that is imported here in the United States, or they did, but they can't pump it here, or they can pump it, but they can't pipe it here because Keystone Pipeline, which was bought by the Canadian government, was canceled by this administration. So hell yeah, we can blame the Biden administration for some of this inflation. And I'll refrain from that again, but heck yeah, they are directly responsible for gas prices and what we are seeing here. So you're trying to spread this around that it's Putin's fault, that it's everybody else's fault. Meanwhile, this president is flying to Saudi Arabia and won't go to Alberta and won't pick up the phone and talk to Justin Trudeau about getting Canadian North American oil here. That is security. Let's not stop going to our adversaries and go to our allies. All right, so need to take a breath here a moment, and Mr. Powell. I'm glad you are here, and I do believe you attempt to be less political than maybe some of your other predecessors, but I do want to briefly point out something that Mr. Stiles and Mr. Timmons raised earlier regarding your comments in February 2021 as Congress was debating the Biden stimulus. Mr. Timmons cited those comments earlier. Well, in fact, your quote is still highlighted on the website of the House Budget Committee, the majority's House Budget Committee, under the headline, quote, experts and leaders agree the country needs the American Rescue Plan now. So your words are listed alongside quotes from the Minneapolis Reserve Bank president, the president of the Federal Reserve Bank of Atlanta. And again, this is from 2021. And I just wanted to hear, the hearing record to reflect this timeline, first of all, and ask you, do you think that maybe your quote should be taken down from that website, knowing what we know today?
It's not up to me whether people take down the quote.
Well, let me tell you though, if you're trying to be apolitical, that and allowing those words to stand with this mess that has been created in the economy doesn't stand. So I guess that's up to you. But if you're going to strive for that, I would suggest at least have some of those folks sitting behind you. They might want to make a phone call. All right. We have discussed during your last visit that I've long advocated for a rules-based approach to monetary policy. We talked about the Taylor rule. I've suggested the Yellen rule. Now with your reappointment, it could become the Powell rule. I don't care what it's called, but I am very concerned that we are not looking at those guideposts and having those guideposts. I'm glad to see that that in the Fed's most recent report, you did once again include a section on monetary policy rules, which had been omitted from the previous version, and you and I had discussed that at that. I want to read a quote from the June report and then get your thoughts. Although simple rules cannot capture complexities of monetary policy and many practical considerations, make it undesirable for the FOMC to adhere strictly to the prescriptions of a specific rule. Some principles of good monetary policy can be illustrated by these policy rules. So my question is this: what principles do you believe are important when the FOMC is making decisions on monetary policy?
Well, what principles are important? Well,
And we've got a minute with a quick gavel, so please go.
sorry. So, you know, I think to try to think systematically about monetary policy and not be, you know, fully discretionary, you know, to try to have a frame of reference. What are we trying to do? The Taylor rules, what they do is they embody the dual mandate. It's really what you're looking at in the standard Taylor rule and all of the spinoffs is how far are you from your price stability mandate? How far are you from your employment mandate? And that tells you, it's a frame of reference. And I think that's a useful thing to have.
Okay. We got 30 seconds less. Obviously, what I'm trying to push for is more transparency from the Fed. I also want to very quickly revisit your interaction with Mr. Gottheimer, where you spoke about the importance of preserving innovation and competition in the digital asset marketplace, which I agree with 100%. In fact, Republicans on this committee included that as part of their working principles last year. So let's talk about that light touch that when it comes to legislation. However, one of my colleagues also noted that regulators right now are being very heavy-handed, which I'm concerned about as well.
Expired.
And I will follow up in writing on that. But we need to be hearing about how heavy-handed regulators are. Thank you. I yield back.
Thanks.
The gentleman from Illinois, Mr. Caston, is now recognized for 5 minutes.
Nice to see you, Chair Powell. I want to just start by thanking you for your service over these last couple of years. I know you and I have talked before that your rhetoric, your language, making it clear to all of us and to the nation that we needed a balanced fiscal and monetary policy in response to the downturn created the political space for us to do what we did. I don't think we could have done that without your voice. And the fact that we had not only as rapid a recovery, but as equitable a recovery as we did was because we had that space. And I think history will show that we owe you more gratitude than we've given you. And I thank you for that. The fact that wages grew fastest for the bottom quintile did not happen but for that fiscal policy that complemented what you were doing. And yet we find ourselves today with people talking about fear of a recession. And I would submit to you that the fear of a recession is not because our economy is weak, but because our democracy is weak. If we were to use our tool on this side of the dais to say, what should we do to address labor markets? We'd reform our immigration system. What should we do to reduce people's exposure to high-priced volatile fossil fuels? We'd make massive investments in cleaner, cheaper energy. What should we do in response to housing supply constraints? We'd invest in housing. I could go on and on. Everything on that list is deeply, deeply partisan because the markets are looking at the United States and saying, do people in this line of work, those 537 of us who have the privilege to hold federally elected office, do we see human pain and suffering as a problem to be solved or as a frailty to be exploited for our political ends? They look at my colleagues who 2 years ago thought it was harder to stand up to Vladimir Putin and support Ukraine and say they're going to do the same thing again. They look at the talking points that all of you get every Monday that says, talk about Biden's energy crisis, his border crisis, don't do a damn thing. I admire your obedience. Do you have an ounce of leadership in your bodies? And so now we're left here in this moment, and I'm not going to ask you to opine on policies. I understand you can't do that. But you were so eloquent 2 years ago in saying, if we don't balance fiscal and monetary policies, we are going to be looking at a recovery that looks much more like the Great Depression or the 2008 recession, where it was a long, slow recovery. What concerns do you have right now if the only tools we use to respond in this moment is monetary policy?
Well, honestly, as you can imagine, I'm very focused on monetary policy, and I think that the thing that I assume you're hearing from your constituents at home is about inflation, and that is our assignment. You know, it's not that we control all of it.
Well, I guess, and I'm sorry to interrupt, but we are. But when I talked to the CFO of a manufacturing company a month ago, and he said, my business school teacher taught me to do just-in-time inventory, and now I'm trying to manage to just-in-case inventory. That requires capital. We talk to chip manufacturers who are saying, I need money to build, but I need a labor force to grow there, and I don't know how to do that unless I have access to capital. Raising rates is great at curtailing demand. It's also great at curtailing supply. So what concerns do you have if all we do is raise rates?
Well, you're right. There would be supply effects as well. For example, to look at housing, you know, if housing starts will slow down, and I get that. But ultimately, we have a job to do, which is to restore price stability so that the economy can function well. It's really the bedrock of the economy, and it's most important for the people at the lower end of the spectrum who are now seeing their wages and savings eaten up by inflation. So we need to do that. There's lots of other things that need to be done in the economy, and that aren't the business of the Fed, but we have that job, and that really is our focus, along with, of course, preserving a strong labor market. The two mandates are equal. In the current situation, the labor market is very strong. It's extremely strong. Two vacancies for every unemployed person, 3.6% unemployment, and wages moving up. So it really is a question of getting inflation under control, and that is you know, that has to be our focus.
Well, I guess I would just ask you to use your voice as eloquently as you have over the last 2 years. I'm not asking you to tell us how to do our job, but the supply pieces matter. And when the market is baking in a recession, I can justify that logic if the only tool we use are the tools under your purview. Thank you. I yield back.
The gentleman yields back. The gentleman from Kentucky, Mr. Barr, is now recognized for 5 minutes.
Mr. Chairman, I visited with farmers in Fleming County, Kentucky last Friday, and my constituent Charlie Masters asked me to emphasize the extreme pain he and other hardworking Americans are experiencing as a result of this inflation crisis. And specifically, he told me that he couldn't afford the skyrocketing cost of diesel fuel for his tractor. He added that, quote, "I don't know how the government says the inflation rate is 8.6% because for those of us in the real economy, it feels more like twice or 3 times that rate." That's how painful this is, Mr. Chairman. I appreciate your humility in acknowledging that both the Biden administration and the Fed were wrong last year when they assessed inflation to be transitory. Clearly, the failure to more urgently tighten monetary policy was a serious mistake. So while far too late, I appreciate the current commitment to aggressive tightening, including the recent 75 basis point rate hike. But on behalf of Mr. Masters and my other constituents who are suffering with these price hikes, I encourage the Fed to exercise fortitude in restoring price stability and staying focused, even in the face of financial market volatility. Staying focused on fixing the supply-demand mismatch in our economy. So I have a question about the demand side and one on the supply side. On the demand side, clearly within the influence of monetary policy, the Fed has stated that its inflation target rate is 2%. The inflation rate last month was 8.6%, and as my constituent pointed out, it feels even worse. Given the chasm between where we are and where we need to be, do you anticipate any effort within the FOMC to increase its inflation target to 3 or even 4%? And will you commit to resist any efforts to change the inflation target that would make it even more difficult to anchor inflation expectations?
No, that's just not something we would do. We're shooting for 2%.
Great. And will the FOMC consider reversing the adjustment to the inflation targeting framework that it made in around August of 2020 to get back to a target of 2%?
We'll revisit that in a couple of years. I will say that that's really not the story behind why inflation is so high right now.
I acknowledge that, but given the work you all have to do, I would offer that as a consideration for the FOMC. What is the end point for your balance sheet reduction efforts?
Well, it really is when the balance sheet is at a size that that we can conduct monetary policy roughly in the range of 2.5 or 3 trillion, smaller than it is now.
Okay, and we were at 4 trillion. Now we're at 9 or a little less than 9. So you're saying 2 or 3.
We look at it as a
roll.
Sorry to interrupt.
Okay.
We look at it as a percent of GDP, really, and so we're trying to get back to roughly the level of GDP we were at.
I see. On the supply side, you testified earlier that supply chain issues and the price of oil are out of your control. I respectfully disagree in part. Certainly, the Fed does not and should not implement fiscal or energy policy. But in light of the impending confirmation of Michael Barr as Vice Chairman of Supervision, I am concerned that the Fed's regulatory framework could exacerbate supply constraints, and specifically forcing banks to sideline capital that institutions could deploy to spur business investment, gold-plating U.S. banks' capital requirements seen recently with the Basel Committee's modification to the GSIB surcharge in the EU, which reduces our domestic competitiveness, and especially the climate finance agenda and climate stress testing that would redirect capital away from fossil energy precisely at the wrong time when we need more, not less, investment in fossil energy, and when a gallon of gas is $5 nationally and rising. Do you acknowledge the role at the Fed related to business investment, regulation, further constraining potentially supply?
Well, we certainly do not want to be and are not in the business of allocating credit either to or away from any particular industry. We want those decisions to be made in the private sector.
Well, on the regulatory supervision side of the House, there is a supply side impact, and excessive regulation, especially in the climate finance area where we need more investment in energy, that could have an impact on your inflation fight. Finally, a question about Fed independence. Last week, my Democrat colleagues passed a bill out of the House that would add to the Federal Reserve's mandate by tasking the board with the additional responsibility of addressing racial and socioeconomic disparities rather than remain focused on price stability. My question is, when inflation hurts minority and low-income populations the most, do you believe giving the Fed new responsibilities that fall outside of its core competency would politicize the Fed and compromise your independence precisely when you should be focused on combating inflation?
The gentleman's time has expired.
We'd love an answer to that question, Madam Chair.
I think Mr. Powell can submit that in writing and forward it to you.
Then I'll just say, I think the public...
Just very quickly then, because we've got
Sure.
people waiting and you have a hard stop at 1.
I just was going to say that the public's been well served by the dual mandate, and I would be concerned with any statutory requirement that sets us up to be accountable for achieving things that we can't achieve with our tools, and I do think that's a concern.
Thank you.
Thank you. I yield back.
Gentleman from New York, Mr. Torres, is now recognized for 5 minutes.
Thank you, Madam Chair, and thank you, Chair Powell. As you know, one of the dominant drivers of inflation is housing. The affordability crisis is one of supply and demand. The demand for affordable housing far exceeds the supply. Do you believe, as I do, that public investments in an expanding housing supply would bring us closer to addressing the housing affordability and housing inflation crisis?
So I would agree that housing is in short supply and there's an issue there, but the question of how to address that is one for you.
Right. But if public investment had the effect of expanding the housing supply, that would have an impact on reducing inflation in the long run. Is that a fair assessment?
Again, I'm reluctant to be drawn into supporting.
Nope, I'm not just an objective description of the impact. I'm not asking for you to express support.
I think more supply generally, means that demand
lower prices, right?
Constant, then prices would be lower.
Okay. Even if you raise interest rates, prices might nonetheless remain high because of supply chain disruptions. Catastrophic climate change will, over time, open a Pandora's box of supply chain disruptions. Is it fair to say that catastrophic climate change, if left unchecked, will likely lead to more inflation and not less, and will likely render the Fed less effective at reducing inflation?
Would climate change do that?
Yes.
Over a very long period of time, I think it'd be very hard to say, and it'll depend on what's the governmental response. It'll depend on what's the private sector response. It certainly has the potential. I think some people think that dealing with climate change will put upward pressure on inflation, though.
But in the long run, if climate change disrupts the supply chain, right, that will obviously lead to higher inflation, and that's the kind of inflation that the Fed would have most trouble reducing. Is that fair to say?
Yes, but again, I'm reluctant to get into an issue that we're not climate policymakers.
Yeah.
We don't have to weigh these decisions that you do. It's really a question for elected officials.
Regarding the present, how much higher could the interest rate go? What does the worst case scenario look like?
How much higher could the interest rate go?
Yeah.
So, no higher than it needs to go, but we think.
But what's the worst case scenario?
I wouldn't say worst case, but I'll tell you what I think. The point is to get. We think that first of all, financial conditions have tightened very broadly. But the federal funds rate, our own policy rate, is still quite low. So we want to get it up to neutral pretty quickly, and then after that, we think it needs to be in a place where it is moderately restrictive, meaning above the neutral rate. And that's only appropriate because we have inflation at a 4-decade high. So my colleagues and I wrote down sort of a range of 3 to 3.5% by the end of this year, and then maybe 3.5 to 4%. Now that's all highly conditional, based on many assumptions. I think we'll do what makes sense as we go, but those are rough estimates, I think, of what we think might turn out to be appropriate.
And then the Fed has a target of 2%. How long will it take you to reach the target?
So we, in forecasts, I would say generally my colleagues and I expect that inflation will move down over the course of the next 2 years, much closer to the target.
My understanding is that one of your projections is that headline and core inflation will subside in 2023 to 2.6 and 2.7% respectively. Is there any historical precedent for reducing inflation as rapidly as the Fed is projecting?
Well, yes. I mean, unfortunately, Paul Volcker had to do something very much like this, much larger, on a much larger scale. And but yes, we core inflation, core PCE inflation has actually tracked down a little bit from the very hot levels of late last year, and is closer to 4%. So I think it's plausible that through using our tools and ideally the supply side healing, that we could get inflation down to those levels next year.
As I understand it, there are two models of CBDCs, intermediated and disintermediated. The Fed can either operate through the commercial banking system, or it can enable consumers to have direct accounts with the Fed. Which approach are you inclined to favor?
Intermediated.
Intermediated.
We actually don't have legal authority to provide accounts to anyone but depository institutions.
And you said the Fed has said it does not intend to proceed with the issuance of a CBDC without clear support from the executive branch and Congress. Do you see congressional authorization as a policy preference or as a precondition for creating a CBDC?
I think we'll need to have an authorizing law, and I think we haven't decided whether we think this is in the public's interest. If we do, we'll come to you. Again,
But as a matter of law, or is it a policy preference? Like, what is your view?
It's a matter of law.
As a matter of law, okay.
Yeah.
I see my time has expired, so.
The gentleman from Arkansas, Mr. Hill, is now recognized for 5 minutes.
Thank you, Madam Chair. Mr. Chairman, thank you for being on the Hill this week. We greatly appreciate it. And I wanted to change subjects. You've had a lot of good interaction today, and I want to talk a little bit about a rising interest rate environment and the impact on the Fed itself. The New York Fed released projections for the Fed's balance sheet as a part of its annual overview of its 2021 open market activities. And they announced to the public that the Fed portfolio could run a projected loss of about $300 billion through 2024 as interest rates continue to rise, since you have an enormous, biggest in the world, I guess, fixed income portfolio. The Fed's most recent financial statements for the first quarter show an unrealized capital loss of $450 billion during the quarter. So my first question is, does the Fed need a positive capital cushion in order to carry out its mission as our central bank?
No, we don't.
Can you explain to people why not?
Sure. So what we do is, our liabilities, our currency, for example, is a liability to us, and it doesn't earn, we don't pay any interest on it, but we own the contrary asset as Treasury bills, so we actually have substantial earnings, and we give those to the Treasury Department by law over the course of the year, and we've given $1 trillion worth of those earnings to the Treasury Department over the year. So we don't retain it as capital because we don't need it. It's literally not required for us to conduct the operations and do monetary policy. We don't, and we have a very thin sliver of capital, but it's sort of symbolic. It's just not something, we're not a private institution.
So as interest rates increase and you have to pay out interest on reserves, and you've got about $9 billion, I think, of operating expenses, there is a point in this interest rate increase where potentially you'd be at an operating loss, I take it, and that you would not be having a profit to distribute to the Treasury. Is that possible?
Yes, that can happen, but again, it will have no effect on our ability, no effect whatsoever on our ability to conduct policy, and it's not something we would consider in setting policy.
Right, and you just would treat that as a deferred asset, is that right?
Yes,
In other
we
words, this is
capitalize
money
it.
you owe back to the Treasury when you start making a profit. You'd pay that deferred, you'd write that deferred asset off, right?
That's exactly right, and we'll pay it back down to zero.
So how does it then, since the Congress has imposed on the Fed an obligation to pay for the Consumer Financial Protection Bureau all their operating expenses, they just send you a memo and ask you to pay for that when you don't have cash? Is that added into that deferred account asset?
Yes, as a practical matter, it would be. It would be very
It's
small.
small compared to your overall operation, but
Yeah.
it's one of those, I think, errors I think Congress made, honestly, by imposing on our independent central bank, an obligation to, in theory, fund an on-budget operation. In retrospect, over the last 10 years, do you agree philosophically that ideally the Fed earnings wouldn't be earmarked for a particular on-budget operation?
In a perfect world, we would fund agencies through different means. Either many of them are self-funding. They get funding.
Yeah, I agree with you. I think it ought to be on appropriations. I've always felt that way. I think it puts the Fed in an unusual position. And here, as rates rise and your earnings may go negative as you pay out more earnings than you obtain and unrealized losses, this just puts that in mind. Let me thank you. Last time we were together and you were before the committee, we noted in the review that the rules regarding potential monetary policy rules had not been included in the report to Congress. So thank you for putting those back in to the Congress. And I heard you talk to Senator Tillis yesterday about the importance of rules. Can you tell us again how you use rules like the Taylor rule to help guide you in interest rate policy?
So they're just embedded in the work that we do, deeply embedded. And basically, anytime you make a forecast, you have to make an assumption about monetary policy. And so what you do is you use some form of a Taylor rule, and there are many different iterations at this point. I think, but more fundamentally than that, we do try to be systematic in monetary policy, and rules. You consult rules and help.
So let me just in the few seconds remaining. Taylor rule indicates, I think, short-term rates might be in the range of 6%. You're not there yet, obviously, to fight inflation. How do you get there, and over what period of time?
So the real test is that financial conditions need to be they need to be in a place where they're causing the desired outcome in the economy, and that's what. And so there's been so much tightening that isn't reflected in the overnight rate yet.
Right.
So really, we've done a whole lot more than the changes in the overnight rate would.
I thank the chairman. I yield back.
Thank you very much, and I thank the gentleman. The gentlewoman from North Carolina, Ms. Adams, is now recognized for 5 minutes.
Thank you, Madam Chair and Chair Powell. Good to see you again. I'm happy that we can now congratulate you on your confirmation as you continue to serve as chair. Also, I'm delighted that Dr. Lisa Cook, an HBCU graduate and the first Black woman on the Fed board, and Dr. Philip Jefferson, the fourth Black man, and someone who teaches in my district at Davidson, have joined you as well. So, as we've discussed before, you know how concerned I am about the housing market, and according to your February monetary policy report, our housing shortage has been intensified by the growing cost of construction materials. So, Chair Powell, how do you think the Fed's interest rate increase will impact the cost of construction?
So I think it's going to lead to, and it is leading to, a slowdown in the housing market. You're seeing fewer buyers. You're seeing housing starts move back. That the housing market's going to be cooling off. It's been very, very hot. Price increases have been extraordinarily high. And it's one of the channels through which monetary policy works, is interest-sensitive spending in particular. So I do think it doesn't directly affect construction costs, to your question, but many home builders do work on borrowed money, and it'll certainly affect their profits and their activities.
Thank you. I've heard firsthand from construction firms, from affordable housing providers, my city and my county, and many others about the increase in construction costs and how seriously hampered these groups are to build more affordable housing. So, yeah, I think we need to really pay a lot of attention to it, and it's really of concern. So, thank you very much. I know that I'm out of time, and you probably are as well. So, thank you, Madam Chair. I'll yield back.
Thank you so very much. I'd like to thank Chair Powell for his testimony today. Without objection, all members will have 5 legislative days within which to submit additional written questions for Chair Powell to the chair, which will be forwarded for his response. Chair Powell, I ask that you please respond as promptly as you are able. Without objection, all members will have 5 legislative days within which to submit extraneous materials to the chair for inclusion in the record. This hearing is adjourned. Thank you.
Thank you, Madam Chair.